So just because in all of these cases, EKSO, LQMT, and ISCO, all three of the stocks went further than I thought. But I'm also showing you some of the best trades that I've done over the past few years. And this does not usually happen. Most of the time, the stocks don't get to where I want. So you'll see that as I start to show you some others. But I wanted to show you, just get you a vision of how a trade really can work out nicely. And even if you don't time it correctly, I'm making 70,000 here, I'm making 120,000 there. I mistakenly said, 150,000 between the three. It's actually closer to 200,000. Just think about what that money means in the real world for a second. It's tough to, go back and forth and say, hey, here are my trading profits. Here's what that can buy in the real world. But sometimes you have to, when you're up 100,000 in a day. And perhaps this kind of thinking has prevented me from, becoming a truly great trader and making tens, if not hundreds of millions of dollars because, for all intents and purposes, my strategy isn't that scalable, but I do underestimate a ton of stocks and I cut my profits way too quickly. But for me, I'd rather have a very low risk 4 million and 4.3 million now or 4.2 million in profits rather than a higher risk, maybe 10 or 20 million. I do what makes me comfortable. And I think this is one of my most important lessons where no matter if you're a beginner, intermediate, or veteran, you all have to figure out your comfort level. And maybe sometimes if you're doing really well and you're like, okay, let's take it up a notch. For me, I was everything's backwards for me because I made so much when I knew hardly anything, and now I've gotten more conservative. But 2014 is a record year for me, so I'm feeling very confident with my rules and my risk. Um, just because EKSO and ISCO and LQMT all went further than I thought, that doesn't mean that I'm going to take bigger risks. I have set risks that I have in my mind. So sometimes stocks can go further, but I'm not going to change the way I trade them. I'm just going to chalk that up and say, hey, I was more right than I thought. Um, Also, I rarely ever hold stocks if they go like 10 or 15 cents a share away from me, or never more than 5 or 10% away from me if I'm trading a lower price stock. If you're trading a 20-cent stock, like the 10 to 15 cents a share doesn't really apply. I rarely trade 10 or 20-cent stocks. Right now, I'm currently short Blatant Pump MEDA, which we'll go over when I talk about short selling. But usually I'm trading stocks between two, three, four, five, $6 a share. So I keep a very, very close watch on my stocks. So 10 to 15 cents, like I'm done. And I think that's why in 10 to 15 cents away from me. That's not to say if I'm up 10 or 15 cents a share, I take profits. Sometimes I do take profits of 10 or 15 cents a share when the stocks aren't going up as much as I want, but that's never my goal. That's a big assumption that a lot of my critics make where they think, oh, Tim just wants to make 10 or 15 cents a share and then he's out, because they're not looking at how I trade. They're not looking at the analysis. They're just seeing the end result. And frankly, a lot of my trades do make me 10 or 15 cents a share, but I'm aiming for higher and something just goes wrong along the way. Um, but overall, because I'm so cautious, this is why 2014 has been my most successful year in trading and in teaching. I got to give credit to the bull market, but also discipline, 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 discipline. I have no big losses in 2014 for the first time ever. In past years, I've always had big losses, and that sucks. I've made money. I've made six figures pretty much every year that I can remember with trading, starting in year one. But heart attacks, big losses, I don't like that. I can barely drink anymore now that I'm in my 30s, and I can't take big losses. I just don't have the patience, and I think my discipline really has grown. So, I'm having a record year of up nearly $1 million on the year. That beats my 2000 record earnings of 700,000. So when you have a record year, you continue to do whatever you're doing that's working. And it's very important for you to spell out your potential risk and potential reward before you make the trade. This is such an important lesson. You don't get into the trade and say, okay, what do we have here? Am I going to make 5 or 10 cents? Am I going to lose? No. You need to have it written down or in your head ahead of time. You go into every single trade with a specific plan and try to stick to it. And I know it's tough to stick to. I know life gets in the way. I have a crazy life. Sometimes, the stocks move too fast. Sometimes there's breaking news in the middle of the day. Sometimes there's unexpected news overnight. But at least try to have a plan and try to stick to it. Because if you deviate from the plan, your risk is unlimited. And even if it's a good pick and you profit eventually, you have not done well. This is kind of crazy where most people think, oh, I profited, good trade. I profited, good trade. Well, after you start trading and learning how this game works for a while, you'll eventually realize that some profits that you make are not good profits. Like my $7,600 that I made on ECRY shorting it the other day. I freaked out. I did not stick to my plan. It is a terrible $7,600 in profits. And I know most of the people watching this DVD would love to make $7,600 in a day. But for me, shorting a bread and butter, pump and dump, pattern worked exactly the way I thought. The price action was the exact way I thought. And I lost my plan and I deviated. And that sucks. I'm very grateful for the 7,600. I'm proud of the fact that my plan was dead on and it actually went much further than I thought. But at the same time, I did not trade it well. And once you get rich enough, and I hope you all have this problem, where you start judging your trades not based on dollar profits, but based on how well you stuck to your plan and how well you executed. If you talk to Michael Good, Tim Grittani, LX21, and all the millionaire traders that I know, sometimes they're not happy with a big gain. And newbies don't get it. They're like, what are you talking about? You just made, thousands or tens or even hundreds of thousands of dollars. How could you not be happy? And it's because, we don't trade it well. We haven't capitalized on the opportunity. We didn't stick to the plan. We traded too small, traded too big, got too freaked out for some reason. There's a million things that can go wrong with a trade. But by having a plan and sticking to it and really thinking about the plan every second, like when I'm in a trade, I have my finger on the trigger button where I can get out at any second. It's no different than if you're like a fighter jet pilot and there's something wrong with the plane, and you put your finger on the exit button where you can blast off out of the plane in case it explodes or an enemy has locked their missiles on. I mean, you eject, and that is no different than my trading. And a lot of people are surprised by how quickly I eject from a trade. They're like, come on, Tim, give it more time. And I'm like, nope, 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 nope. I am not a fun trader. I'm not a fun trader to follow. I can imagine how frustrated some of my students are, but I play it overly safe. Remember, I am a penny stock day trading short seller for the most part. And when I'm a buyer, I recognize the fact that most of these stocks crash and burn within a few days or a few weeks. So I don't want to hold on to these kinds of things for very long. And that makes me very safe and conservative. But even after 15 years, I'm still undisciplined every now and then. This is my first year. Freaking ridiculous. 15 years in, and this is my first year with no big losses. It's crazy. And as we go into some of the other millionaire traders who we'll profile, you'll see that they have big losses every now and then too. So it's not just me who's undisciplined. It's a human thing. And perhaps that's why, algorithmic trading is going to take over and we'll all be replaced by machines one day. But for now, we have to embrace our humanity. We have to accept it and just come to terms with the fact that sometimes you're going to be undisciplined. And I cannot spend too much time on this saying the word discipline. I know some of you guys don't even know what the word discipline means, but it basically means formulating a plan, using your best guess to say, hey, I think this stock can, my potential reward is here. I think this stock can go here, whatever the price may be. And here is my risk. And ideally, your risk is much less than your potential reward. And if for whatever reason the stock does trigger your risk point, then you have to get out. And that's not to say that you use hard stops. I don't use any hard stops. I know that many people are conservative and they're like, well, just place your stop limit there just in case, and you stop out of the trade and you protect yourself. I don't like using stops. Market makers can see your stop limit prices and they oftentimes bring the price to a stop price just to get you executed and out, and then they bring it right back up. And I see this sometimes where I'm about to exit a trade because I'm trying to stay disciplined, but then it pops right back in the right direction and I pull my finger away from the trigger button, you know? And I think of, what was that old Christopher Walken movie where you could see the future and, you could see Martin Sheen, pushing the button to end the world with a whole nuclear war. And that's how I have my finger on the trigger and I can pull it back if the stock starts acting right, because sometimes stocks fake out for a few seconds. And even though I'm very disciplined, that's not to say I'm an idiot. Tim Grutani, my second millionaire student, has kind of adopted a cut losses intelligently plan as opposed to just cut losses quickly at all costs. And he's been very successful with that. It has hurt him. He has gotten undisciplined sometimes. He has had some big losses this year. But he's also up like 1.2 or 1.3 million, and he's like doubled his account in the past year. So there's some credibility to cutting losses intelligently as opposed to mechanically. And algorithms and robotic trading, they'll never understand that. That's a very human function. So I'm going to just repeat this one more time. Use this as a drinking game if you want. This is what makes trading tough. You must stay disciplined. Those of you who start to trade without a plan or flawed plans, like let's say, you think, okay, I think this stock could go up $1 a share and I might be wrong, so maybe it's going to go down $1 a share. That's 1-to-1 risk reward. That's not good. Or maybe you think that it can go up 50 cents a share and you're willing to risk $1 a share, and now your risk reward is negative 2-to-1, which is terrible. I'm unhappy if I profit, but I don't stick to the plan. And again, you will be feeling this too if you stick to my entire, journey that I have laid out for you, where you try and become the best trader and the most disciplined trader, and you use your early months as a trader not to try and make the most profits, but to learn the best lessons and model yourself and really learn the right framework to successful trading. I know it's tough. I know everybody wants profits. And I know you think I'm crazy if I'm unhappy if I profit but don't stick to some stupid plan. But if you get on the right path and you develop good habits early on in your trading career, that will come back 1,000-fold when you have a bigger account later and can take bigger positions. A good trade is not determined by the outcome. It's determined by your planning and ability to stick to that plan. Let me just repeat that. A good trade is not determined by the outcome. It's determined by your planning and ability to stick to that plan. On every single trade, when I say review the lessons from the trade, that's not to say, okay, I made 50 bucks here, I lost 100 bucks there, I made 100 here, I lost 1,000 there. I'm not saying review your profits. I'm saying review your plan and see how well you stuck to it, and then see how the profits or the losses followed. And that way you can try and create a framework in your mind. I didn't say this was going to be easy, okay? If you want to be a millionaire, you have to do these nasty little things. It's not that hard. This isn't rocket science. You can see I've shown my lack of math skills multiple times, and it's just a question of how well you stick to your plan. The best traders I know always trade via their plans. I don't know any millionaire or multimillionaire who's just like, yeah, let me buy this, let me short this, gut instinct, I got a tip on this. No, they're all very logical. And some of them are, very weird in person because they've internalized this so much and they're like robots when you talk to them. And some of the richest people I know are like robots. Obviously, I don't have that problem yet, but I'm also very undisciplined, as evidenced by me taking 15 years to finally stick to my plans. So let this be a lesson to you. Play this video over and over again if you ever have any questions about how to create a plan and how to stick to it. This is why I say cutting losses quickly versus cutting losses intelligently is totally up to you. There's not one right answer. It depends on how safe you want to be or how aggressive you want to be. I made my money at first with no risk precautions at all. I was very lucky though because I was 1999, 2000. We're in a bull market, but we're not in a bubble. Tim Grittani has made a lot of money by cutting losses intelligently, but just the other day, a few weeks ago, he lost over $300,000, which is a giant loss. And, had he cut losses quickly, that would never have happened. But then again, had he cut losses quickly, he probably wouldn't have $2.3 million right now. So it's a fine line. And, you as a student, I don't know, I can't meet all of my students. I have students now in over 70 countries. I love to travel, but I'm already overloaded. You have to choose what's best for you. For me, I recommend cutting losses quickly, especially as a newbie, just because you don't know how to cut losses intelligently. But maybe as you get used to the system and you get used to these crazy, volatile stocks, then you can start to say, hey, let me give it a little more breathing room. Again, you have to choose hard stop losses versus mental stop losses. I have never used a hard stop loss. A hard stop loss is you can enter it with your broker and you can say, look, if the stock breaks this level, like let's say I'm in a stock like LQMT at 55 cents a share where I bought it, if it drops below 50 cents, the sell order automatically becomes active and you don't even have to watch it. You can leave the computer. The problem with that is that the market makers see hard stop losses and they sometimes screw around with penny stock prices and they'll drop a stock like LQMT down from 55 to 50 if there's enough stop losses, and then they'll put it right back to 55. I don't like that. I don't want to get faked out by a market maker only to see it get put right back on the right track. And then, if I'm away from my computer and, the stock is acting exactly right, but I don't have a position because my hard stop loss got taken out. So I use mental stop losses, but this also involves you sitting by a computer or smartphone and watching the stock much more carefully. For me, that's how I like to do it. That's probably why this year I don't have any big losses. Because I play it very safely. I don't know how to go to like Vegas and gamble. Well, I don't gamble in Vegas anyways, but if I gambled in Vegas, I wouldn't put like $10,000 on the table and then tell some schmuck next to me to be like, hey, watch this. I have to go take a quick piss. I'm not going to do that. I would never see him again and my money would be gone. I like to watch every single dollar that I have. And that's why I'm so careful. And thanks to this bull market, we have so many opportunities. You can have record years while being safe. But you also have to recognize different risks and different goals at different times of the day. As I said, I like to hold stocks overnight. One of my favorite patterns is to buy a stock in the afternoon and sell it the next morning. That is my goal. And, it's a very time-specific trade. I don't hold it very long. The next day, people, I don't know why they're surprised, but I hold it maybe a few minutes after the market open. And my goal is to sell into a giant, gap up or morning spike. You see two of the biggest spikes and gap ups that we've had. EKSO spiked up or gapped up $1 a share. Then later it spiked up $2 more a share. ISCO gapped up from 17 to like 29, so we had a $12 gap up, and then over the course of 2 days it spiked another $20 a share. So sometimes I play it too safe, but I go in with a very specific goal. So you must consider your own schedule and your own time on every trade. I travel a lot, and some people knock me for it, but it helps. I trade way too much if I'm just sitting at home and I have nothing to do, and I'm just bored, and so I say, hey, let me trade, and maybe I can feel good about myself and make a few $1,000s and give a good alert to my subscribers. When I travel, I don't screw around. I don't trade subpar setups. And don't worry, I know I've only showed you 3 trades before. We have a lot more trades to go through. This is a long-ass DVD. But if I'm traveling, I'm much more particular with the stocks that I'm trading because, if I'm on a plane, that hurts my ability to trade because the Wi-Fi isn't necessarily solid. I've traded on trains before where I have Wi-Fi at the top of the train, and then I go at a hill, and then at the bottom of the hill there's no Wi-Fi. I mean, I've taken some crazy risks. When you read my book, An American Hedge Fund, you'll see that I bet $1 million while I was on a cruise ship, and the entire internet went out, and it was satellite internet. We're in the middle of a storm, and I made, I think, $80,000 if I remember correctly, and that actually put me over the $1 million mark. But that's a crazy, stupid risk. So you have to consider, what dollar loss are you comfortable with? I know you only want to think about dollar gains, but hopefully I've showed you over the past few hours that a lot of traders lose a lot of money, and you have to be extra careful, and you have to really consider this. So speak out loud. Answer this question. What dollar loss are you comfortable with on a trade? I hope you said something. Another one. What dollar loss on a trade would really freak you out? Answer out loud again. Do you need the money in your trading account to live off of? And last, would your family be angry if you lost the money? I'll be even more specific. Would they be angry if you lost all the money in your account? And that is a risk. Let me save this. Would your family be angry? Would you be angry? Would you freak out? Again, the answer is different for everybody because we all have different size accounts and we all have different risk tolerances. My only hope for you is that you think about this before you make every single trade. Be a scared trader. It's okay. Some people come to me and they say, Tim, I'm so scared to trade. I'm sorry. I'm not comfortable. I'm not confident. And I'm saying, don't be sorry. That's great. The best traders I know are scared to lose money. I worry about the people who aren't scared and the people who are like, come on, Sykes, daddy, let's do this. Make me $1 million. Woohoo. Those are the people who don't consider the risk, and those are the people who fail the quickest. And I don't want you to fail. I don't want you to experience big losses. But sometimes big losses can be good for you. Let us talk about Cygnus E-Transactions, CYGT. This is my biggest loss ever. I think that I personally lost about $500,000. My hedge fund lost roughly $1 million on this. And my hedge fund was only like $3 million at the time. So it was a 30% plus loss. It killed all my confidence. It killed all my momentum of trying to grow bigger. And it made me an infinitely better, wiser, and more conservative trader. This is the chart. I invested in it when it was a private company. I want to say I had it at like 30 or 50, maybe 30 cents a share. I don't know. It was definitely in here. And when they became a public company, I was really pumped that, I was up, even though I couldn't sell. I had restricted stock. And then I was so thrilled right here when the stock, kept surging. This was like the best 3 days of my life because I had waited, I don't remember how many months. This was back in 2005 for it to go public. And they basically had invented print-at-home ticketing. They had the coolest solution. Their website, their technology was amazing. I fell in love. And I did not consider the risk. I did not consider, would my family be angry? My family was invested. My parents, my cousins, my friends, we were all thrilled. This was my best friend's dad's company. So it was a true family event. I mean, during Thanksgiving dinner, we were talking about Cygnus E-Transactions, me and my best friend's family. That's how we were into this. And I didn't know it was going to be a penny stock. At this point, I'm 23 years old. I have a small hedge fund. I'm trying to grow the hedge fund, but with my strategy and with my, I was really just beginning to learn how to manage risk. And I wasn't having the big gains that I used to. I wasn't making $700,000 a year. I was making like $200,000, $300,000, $400,000 a year. Not too bad, but when you're a hedge fund manager, that's peanuts. So Cygnus, I thought of my way as kind of trying to cheat to get ahead, by investing, and because I knew the family and because I knew the technology, I could, get bigger dollar gains for my hedge fund. Not cheat as in illegal, but just get ahead in life and, just use this one-time investment to get my hedge fund, prop it up to get more money in the accounts, and that way then I could go back to just normal trading. That's how I looked at it at first. And what I didn't understand is that you can't cheat to get ahead, okay? If you do not followed the rules and the strategies that made you successful, the odds of success are just very low. If Cygnus had worked out and I had made a lot of money on it, I probably wouldn't be here today teaching, and I probably wouldn't even have any money because I would have learned the wrong lesson. Remember, the outcome of a trade does not determine how good or bad it is. This was a bad trade from the get-go because A, I have restricted stock, which means I can't sell. I'm like an insider. So it's not a liquid position. I can't cut losses in case something goes wrong, which is the biggest problem. B, I'm like falling in love with the technology. I didn't listen to the rules that this stock actually taught me later on, not to fall in love with the companies and not to believe the hype. I was full on in. And when it broke out here, I even closed down one of my personal CDs and I threw in, I took a $5,000 hit on a $100,000 CD. I broke it early. I'm like, I gotta buy this. And they had won. Here they were doing some e-ticketing deals or they were dealing with Universal down in Florida, where we were all based at the time, just outside of Orlando. And right here, I don't remember the exact date, but they won a deal with Expedia. And it was to make all of Expedia print-at-home ticketing. And it was going to revolutionize Expedia, their whole attraction business. Expedia today, you still book hotels, maybe cars, flights, but they never really took off with their attraction business. Cygnus won the contract out of 60 companies to make all of Expedia print at home. And they also won a contract to make, it was AOL, what was it called? AOL Attractions? I don't know. All of AOL.com was going to be print at home ticketing. So they were working with some big companies. They had real contracts. So I followed my advice to buy, companies that had good contracts and good fundamentals. But the problem was that behind these contracts, this company was badly in debt. There was all sorts of nasty stuff going on. I still don't know the truth, a decade later. But I saw the press releases right here. In 2006, they won a contract to deliver print at home ticketing to Six Flags. And this was a phenomenal event. I was actually there when we were installing. I was with, I just happened to be hanging out with the Cygnus team that day. It wasn't planned or anything. And they're like, hey, we have to go to Six Flags to install this, new ticketing system. And I was up in New York and Six Flags was in New Jersey. So we drove to New Jersey and I met Mark Shapiro, who was the CEO of Six Flags at the time. Mark Shapiro had formerly had huge success with ESPN. He had created ESPN. He's one of the most successful business people. And we're installing these print-at-home ticketing kiosks. So you print your ticket at home and then you pick up your tickets right outside the gate and you don't have to wait in line. And Mark was shaking all our hands. He didn't know that I was an investor. I was like this, I was 25 at the time. So he thought I was just like a young engineer or something. He was shaking all of our hands and he was like, thank you, thank you. This solution is going to change theme parks forever. And it was actually on this day, around this time, that I broke my CD and invested more because I was like, oh my God, the guy who invented ESPN loves this technology. E-ticketing is the future. This is great. And long story short, they screwed up Six Flags. They screwed up Universal. They screwed up Expedia. They screwed up AOL. And flash forward 2 years, Cygnus eTransactions Group seeks reorganization relief, and they filed bankruptcy. And it was really bad. My hedge fund was already done before this, but the headlines in 2007 when Cygnus, it wasn't bankrupt yet, but this was the stock chart of Cygnus, and it was just declining every single day. I was still selling. I could actually sell in here in 2006. My shares had become unrestricted, so I was selling what I could, but you can see it's just dropping every single day. And Page Six ran this headline on September 21st, party's over for Hedge Fund King. And that was me with my little $3 million hedge fund. I got in a fight with the editor-in-chief of Trader Monthly magazine. Probably shouldn't get in fights with big-time magazine editors. I didn't know the press at all back then. And they made it out to seem like, I was bankrupt and that I had lost everything. And I was trying to tell them, no, my hedge fund only lost 30%. But when your hedge fund loses 30%, you lose all credibility. So this was a headline on a different message board. Cygnus eTransactions incites cilantro demise. My hedge fund was called Cilantro Fund. Like the spice, it's a little different, like me. And it was just bad news all around. And yet, despite all of the bad news, I really was not that sad when Cygnus went bust, when the party was over for my quote hedge fund king days. I had a small hedge fund. I simply got away from my strategy. And by Cygnus failing, it actually helped me understand my rules and value my trading rules much more. So it was my biggest loss, but also my best teacher. So I wrote a blog post about it. I said obituary, CYGT, aka the stock that killed my hedge fund, and I made a little gravestone. I was already teaching at this point when they actually went bankrupt. I still had some shares left that I couldn't even sell. But in the end, it really helped me find my path, as cliche as that sounds. Without this loss, I would not understand the other side of the stock market. I would not understand how people fall in love with technology and really just throw risk and logic and caution out the window. It's kind of funny what actually happened with Cygnus. Here is July 2008. This is when they sold their assets in bankruptcy court to V3 Enterprise Solutions. And this was from Stephen K. Brown, the CEO of Cygnus. And interestingly enough, guess who was in charge of V3 Enterprise Solutions? The very same Steve K. Brown. This is not my best friend's dad. This guy, Steve, actually replaced my best friend's dad as the new CEO. And I was one of the largest shareholders when they were in trouble and they brought this new CEO on. And he looked at me in my face and he said, "Don't worry, son. This is a great technology." And he was coming, I want to say, from Disney or Starbucks, some big company he left to take over. And I had such faith in him, and I just believed him like a fool. And later he bought the company in bankruptcy. He renamed it Accesso. And then Accesso in 2012, which I don't think I've even told many people, was acquired by this company LoQ, and they merged their software solutions. LoQ is a British company, and now they're called Accesso Technology. So they basically were acquired by LoQ, but somehow they changed their name to Accesso. And you can see the current stock price. This is on the British exchange, 610. And over the past few years, it's gone up 6 times. And print at home ticketing is all over the place. And Accesso, aka Cygnus eTransactions, is now a $300 million company. Just to rub salt in the wound, I was right about the technology. I was right about the product. Mark Shapiro, the CEO at the time of Six Flags, I think he actually got replaced too. But he was right that this product would revolutionize the theme park world. The only problem was that the company that I invested in was very mismanaged, full of debts, and the way to get rid of that was to claim bankruptcy and then buy them out in bankruptcy court. And had I known what was going on, I probably would have bid for them in bankruptcy court. But I didn't know the whole the whole conspiracy, for lack of a better word. That is all Stephen K. Brown. So if you meet Stephen K. Brown of Accesso slash LoQ, do me a favor and just stomp on his foot. I don't want you to punch him or get, have to assault him, but just be like, "Stephen K. Brown," and he'll be like, "Yes," and he'll look you right at the eye and you'll think that he's honest, and then just step on his foot really hard and say, "That's from Tim Sykes." Because even though it is a great teacher and a great educator, and it's, this loss has really helped me become much more cautious, it still stings. No one likes losses. As much as I say, remember the Alamo, remember Pearl Harbor, remember 9/11, all of those events sting, and that's, far more important than any financial loss, human loss and national pride loss. But no one likes defeat. So I try and stay positive, and I say, what it has done for me, but it still sucks. It really sucks, especially with the fact that this is like one of the few penny stocks that has actually made it. The product I was so freaking dead on right about, and I did so much research. It was like, ugh. But what can you do? You can't look back in anger, I heard you say. Cygnus was my biggest loss. I definitely lost hundreds of thousands of dollars, and my family, friends, hedge fund all suffered as a result, and I am eternally sorry. Um, but I have learned some rules from it. So never again will I invest in restricted stock that can't be sold. Insiders of companies and institutional investors and big investors, you get this restricted stock that can't be sold. You get a discount to the current price, and there's restrictions on different kinds of restricted stock, anywhere from 6 months to a year to 18 months. And I will never do that again. I don't care how promising a technology company is or any company is. Just the fact that I was so right about Cygnus's product and so wrong about the stock is a great reminder. Never again will I believe in a technology so much and bet so much money with no way to control risk. This is probably the most important sentence of my life, in your life too. You must judge every investment not just by its potential, but by your ability to control risk. If you cannot control the risk, it is not worth anything. It is worthless because you have no idea the downside. And when you can't quantify the risk, how are you going to determine a risk reward ratio? Remember, every trade that I do, I try and do a risk reward ratio. If I can't stem the losses, when a company can go bankrupt and I can't sell the shares, how do you quantify risk? You can't. Never again will I add to a losing position and hope. Hope is not a strategy. For several months, I kept adding to Cygnus, and I refused to believe that they were going to go bankrupt. I was very excited about the new CEO, just to make it even worse that this CEO was going to be the one who would stab me and all the other shareholders in the back. Of course, he didn't tell us that. He just said, vote for me. I'll be a good CEO. And sure enough, he was a good CEO for himself and anybody else who was part of V3 Technology Solutions that bought Cygnus in bankruptcy. But it's a great lesson. I have to keep saying this. You can tell I'm still bitter, even now, nearly a decade later. You never forget this kind of loss, and I hope that you never have to go through it. I hope that you can hear the bitterness in my voice, and that's a good enough lesson for you. But sadly, I fear that you might remember this and take this in, and then you'll be like, well, there's some kind of different deal, and you'll forget this, and you'll have to experience it yourself. And if and when that does happen, uh, you know, maybe at least you'll remember me trying to warn you ahead of time. And if and when it does happen, I apologize in advance. And the good news is that life goes on, um, and you have to take away positive things from such losses. Never again will I invest in illiquid penny stock. This is a great lesson. Frankly, it was just an illiquid stock. Even if I could sell the position, and let's say I got unrestricted stock, I still wouldn't have been able to sell it all. So I don't want to take a big position in a company that only trades a few thousand shares a day. Um, I still have to work on my discipline because I still get caught up sometimes in technology. MEDL was an example in the past year where they specifically said in a CEO shareholder letter that they're working with Facebook, and this is a mobile video social network. And I'm like, oh my God, I'm the one to discover this. And I took too big of a position in an illiquid stock. Um, and I held on to a lot of my shares for months. And I still have a very small position, but it's manageable. So do not invest, do not take big positions in an illiquid stock. I can get out in a day. Do not take a big position where it's going to take you 2, 3, 4 days, a week, 2 weeks, 3 months to get out of your position. I don't care how strongly you believe in it. I know that's going to limit your upside, but it's also going to prevent disaster. And never again will I risk disaster. As I've said many times, and I'm very proud, I do not have any big losses this year. And despite my $1 million, nearly $1 million, $900,000 roughly, in trading profits this year, I'm much more proud of the fact that I have no big losses. This was a very easy way to make a lot of money. Hitting a lot of singles, a lot of $2, $3, $4, $5,000 profits over the year, And then every now and then I've had a few $70,000 profits, which obviously are great. Um, Never again will I get screwed by company management, frankly, just because I don't believe company management anymore. I don't believe a word they say. I understand their role, whether you're a penny stock or a big company like Bear Stearns, right? The day before they collapsed, Bear Stearns, what was it, CFO or CEO was on CNBC saying everything's fine. The next day they're bankrupt. It's not their fault. It's their job description to be a cheerleader. They cannot admit defeat ever publicly because if they do, then shareholders will lose confidence and the stock will crash and whatever crisis they're going through is exacerbated. So they have to be cheerleaders. And I don't understand that, or I didn't understand that. Now I do. Never again will I risk my confidence and possible depression over a position. Cygnus really screwed me up. I know I can sound, I can hear myself, I still sound bitter this long after. Imagine me for the first year or two and with reality TV show cameras in my face. That's why I look like an ass on Wall Street Warriors. The kind of interesting thing is that I was a lovable ass, as so many people have reminded me. But I was really depressed, and it was a really rough time in 2006, 2007 when we were filming that show. Um, I at the time, it's easy now to look back and say, oh, this was an investment. I broke all my rules. That was a mistake. Um, but at the time, it was just another trade for me. I didn't have all these rules, well thought out in my mind or articulated. I didn't have that many students back then. And I didn't differentiate. Now I differentiate. Now I know, okay, if you break all your rules, this is what could happen. So don't break all your rules, especially simultaneously. So now I aim to buy stocks with solid earnings and contracts with big companies like Liquid Metal, and we're about to get into all of the earnings winners that I'd like to buy. I aim to buy stocks that are already moving upwards, so I just piggyback the run up. I don't start it. This was my mistake with MEDL, and I can, pick it out of all the thousands of trades that I've done. Other than Cygnus, MEDL, I fell in love with the technology, or not even the technology, more the potential. I think the technology is crap, but when they're a mobile video social network, and at the time in early 2014, they were a very fast growing mobile video social network, and that CEO shareholder letter saying, look, we're working with Facebook. All it would take was one press release with Facebook, and the thing would go up, like SIMH did, where it could go up 500% in a day. And that could still happen, but now it's been like, nearly a year since that's happened. As of this DVD, I'm long a very small amount of MEDL just because it tends to spike every January. So I'm hoping for a January effect, but it's a very small position. I'm talking like, I don't know, like 18,000 shares of a 18-cent stock, so like a $3,000 position, just so you understand how puny it is. I'm not trying to pump up MEDL. I'm just saying, just in case they have it. That's in my long-term newsletter too. And I'm not telling you specifically about my long-term strategy because that will not teach you how to make millions. That is just for some busy people who want my long-term newsletter, so we have it. These are all short-term trading strategy rules. I aim to take manageable position sizes relative to my account size and daily volume so I can exit easily if need be. It shouldn't be, I need be. You see, I'm like emotional just writing all of this. There's typos, not because I'm careless, but because I can feel the emotion coming up. I don't know if you can hear it in my voice. It's crazy how losses impact you. I make $70,000 on a trade. I'm up 900,000. Like this year alone, I've wiped out Cygnus nearly twice over, and yet it's still talking about it brings me back to that loss. It's crazy. I aim to be alert to all new opportunities daily and not sink too much capital or waste time waiting for management promises. Look at all of these typos. I apologize, but it's good for you to see exactly how screwed up I am. You could be the most meticulous person in the world, but when you start getting emotional about a loss like this, you start making errors, and you see it in my PowerPoint. So this is a big thing. I don't want to be stuck in a position and miss out on other potential plays. There's an opportunity cost. So I don't want that with any one mistaken position. Part of the biggest lesson I got from Cygnus was that I wasted years just holding the stock and hoping and really getting down all because of this one position. And even though it was against my trading rules, just being bogged down by this position and thinking about it every single day, that prevented me from taking advantage of other plays that did fit my trading rules. So I learned, the opportunity cost of a position that's dragging you down and taking up all your time. So I don't want that. That's why I've really, kind of optimized my strategy to be like a sniper where I stay in cash the majority of the time. And in case you don't understand exactly how I trade yet, don't worry, I'm going to do a whole big simplistic overview later on. But I want you to understand how I got there because it's important that you see my process and how I created this process so that you can create your own process for yourself. I know that sounds weird. It's difficult. I wish I could just say, hey, here are the rules. But it's an understanding. As I said in the very beginning, it's not enough just to memorize my rules. You have to understand, why am I making these rules? Why do I have them in place? And why do sometimes, I bend them? And why can you adapt them to your own personality? Um, Anyways, now I aim to buy earnings winners and contract winners on the first or second day of their news. I aim to profit from latecomers seeing the new news and buying the stock after me, or writers spreading the news after me, or latecomer analyst upgrades due to the earnings win and the contracts win. And I'll talk about exactly what an earnings win and a contract win is. But just know that I don't just buy these stocks randomly. I'm not just like, oh, here's this company won a contract. Let me buy it at noon Eastern. No, I want to aim it. I want to aim to buy at a very specific price point. I aim to buy these hot stocks on intraday breakouts, either in the morning or ideally in the late afternoon, not midday and not mid-range. If you buy these companies in the middle of the day, you're not protected by the market close because, if some analyst is going to write about it, they'll probably write about it overnight or right away. There's no one who really has analyst notes in the middle of the day. And analysts do take time to, look at the entire earnings report, or they do take time to look at a new contract. And when they release their report, analysts have tons and tons of followers. They send out their report to their followers first, and then Wall Street hears about their reports. Either way, I want to be invested in the stock before. Sometimes an analyst downgrades a stock after good earnings, and I can't predict that. I'm betting all of this based on odds. If a company reports better than expected earnings and a big contract win that could be meaningful, then usually the odds are on my side that an analyst is going to upgrade it. Somebody who's writing about it is going to be positive. This is why I like buying, fundamentally solid companies. The odds are on my side when I hold it overnight. And it's not just about buying breakouts. Sometimes the breakouts fail, and then you get caught, as you'll see in a few examples. So sometimes I aim to buy these hot stocks on dips if they hold intraday or ideally multi-day and multi-month technical support. Sometimes you can really reduce your risk if, let's say, the stock is already up 20% on the day and it comes down to 12% on the day, and maybe in this theoretical example, when it's up 12% on the day, it's right at 6 months support. And if it can hold that, then odds are it goes back towards the day high, either by the market close or the next day, and then you might have a breakout. And then you'll have all these latecomers trying to buy the earnings-based breakout where you'll have already gotten in on the dip. But just understand that dip buying is dangerous if the dip fails to hold support. If you have an earnings winner that's, let's say, spikes 30% in the first hour because earnings are so good, and then the rest of the day it just dips and dips and dips and dips. I'll show you an example of that. That should not be bought. These stocks need to prove to you that they are worth your money. We work hard for our money. And I don't know about you, I don't want to just give my money away to some crappy company if their stock is just going to keep dropping. I need to see signs that there's stabilization if I'm buying on a dip. I aim to make 50 cents to $1 a share on higher price stocks, roughly $5 to $10 a share price stocks, or 15 to 30% on lower price stocks under $3 a share. I really aim to be choosy. Notice how I phrase this. I don't say I am choosy because I still am like this alcoholic bartender. I still have the addiction. I still have the thirst to trade a lot. And earnings season comes around only 4 times a year. Contracts can be announced any day, which is kind of cool, but you really have to try and resist the temptation to trade every day if you're going to trade these penny stocks. It's not like trading Apple or Google or Amazon where these stocks are trading every single day millions of shares and they're moving up or down $2, $3, $4 a share. All those companies are pretty large companies, so if they do move $2, $3, $4 a share, it's like less than 1%. If you're looking for stocks that are going to move 10, 15, 30, 50% in a day like HGSH, well, you have to wait for them. You have to be choosy. And I aim to cut losses quickly when a stock fails to break out or fails to hold technical support. As I said, if the stock isn't doing what I expect, I'm getting out. I'm protecting my money. I cannot hold a stock that fails to hold support. And the way that you find support is just simply drawing a simple trend line over the past and looking for where a stock topped out at, and that top can now become a floor. And I'll show you examples. And I also, this is a cool little addition, I aim to add to winning positions into the market close since positive news can have legs overnight. Sometimes I take a small starter position just because I'm like, well, maybe the stock isn't right at support and maybe it hasn't broken out exactly. But I'm just going to take a small position just in case, just so that I'm watching it. By taking a small position at first, a test position, it gets me watching it. I want to watch every single stock when I have money in that stock. So I need to put some money in it, even if it's just like 1,000 or 2,000 shares. I wouldn't buy just 100 shares because then I would be like, why am I even doing this? It's not worth my time. At least with 1,000 or 2 shares, I can still make a few $100. And so then it is worth my time. I don't think anybody who trades penny stocks is ever too rich to ignore a possible few $100 in profits. So you might say, okay, good job, Tim. You lost a lot on Cygnus. You learned. Now you only buy companies that have solid fundamental news, which is cool. But learning isn't that simple. You really have to kind of learn a few times until it sinks in. Especially for me, I'm a slow learner. So back in 2007, I was actually writing for TheStreet.com. And the whole goal for TheStreet.com was just to get as many page views as possible. I wanted to be #1 on their website. I wanted to beat Cramer. For a few weeks I was writing really good articles, but this article that I wrote was my worst. And this one actually got me fired. And, it was stupid of me to write this. I said the best stock to buy before earnings. Now I say buy earnings winners, and for me, an earnings winner is defined by a company whose stock spikes in reaction to earnings, not just based on the numbers. I don't care about the numbers themselves. It's all about expectations. And if a company is expected to report X and they report X plus 10%, and they give guidance going forward, and they say, hey, we're going to do better in the future. So they say, going forward, we're Y plus an extra 20% now in growth, then they're upping their numbers. They're upping their estimates, and that's a very good thing. So VDSI, I wrote this article because I said the best stock to buy before earnings. And I wanted the big, page views, and I wanted all the glory. And I hadn't yet learned that, okay, it's good to buy companies with some solid fundamental news, but don't try to predict them ahead of time. This is a problem, okay? When you try and predict news that's coming up, you lower your odds of success. And this is the main problem with CNBC and Jim Cramer and a ton of people, because they're just desperate for content every single day. I don't know if I told you or I was telling somebody, when I was going on CNBC, they requested me to bring 15 to 20 tickers to talk about. And I'm like, there's only maybe one or two good stocks that I'm watching every single day. And, some of them are short sales. And they're like, no, we don't short any stocks, 15 to 20 buys, or else we'll take somebody else. And I was like, well, okay. So I brought up all these irrelevant tickers, and TheStreet.com, they wouldn't let me write about penny stocks or short selling. So I wrote about, a potential earnings winner, and I went for the glory. And this was October of 2007, right here. I wrote about it when it was at, what was it at, 36? Yeah, it's dropped 18% in 36. So it had already dropped from 44 to 36, and I was simply buying this stock because it was in a strong uptrend, and I thought that this little drop from 44 to 36 was, maybe just a correction. And then because of this uptrend was so strong that they should report good earnings. Unfortunately, they reported terrible earnings, and it went from 36 down to like 25 in a day. And I lost 30%, and I lost my job with TheStreet.com. At the same time, it helped me understand, do not guess earning winners ahead of time. When I rebought VDSI, it was kind of ironic that, this is just a really good example from this year, where I bought it right here in the low nines because it was breaking past this resistance. Obviously, it still had resistance at here at 15 and 14, and even a little some here at 11-ish, but it broke above this whole sideways range from like 6 to 8, and it was in the 9s. And I was like, you know what? They reported good earnings. Let me show you what the press release said. They beat by 9 cents, and they beat on revenue. And when you see this beat by 9 cents, beats on revenue, every company, or big company at least, has revenue and profit estimates from the analysts. And, I guess the analysts were saying they expected VDSI to report earnings of 4 cents. So expectations of 4 cents per share, they came in with 13 cents a share, so they beat by 9 cents a share. And revenues were up like 10% year over year, but that's like not a lot of growth. The comment from the CEO, though, in the earnings press release, I think is what really spiked it. It says, we are very pleased with the results. Not only was the revenue reported for the first quarter of 2014 the best first quarter in our history, we also had the strongest intake of new orders of any quarter in our history. The increasing demand for our products is coming from both our traditional products as well as our new products using the Cronto technology. We're making progress with our cloud-based product offering. So he says that they're basically firing on all cylinders. Revenue is only up 10%, so it's not a fast-growing company. And yet, look at what this little breakout did. It went from the 7s all the way up to 30. And this is, sometimes earnings winners can spike for months, not even just a few days or a few weeks. So there's nothing wrong with holding an earnings winner if, let's say you think that their new products and their whatever sector they're in is going to be really hot. I don't like buying companies that only have 10% revenue growth. They're just not fast enough for me. But I bought it in the low 9s, frankly, just because it was uptrending. Here is the intraday chart. Here's a gap. You can clearly see there's several gaps in the chart. It's just when there's so many buyers at the market open that creates a gap. The market makers raise the price up so that it attracts more sellers, and then they can do more execution. Sometimes there's a thing called a gap and crap, where it'll gap up and then just crap out and go straight back down. Here you can clearly see it went from basically 8.20 up to 9, came down to the mid-8s, and then spiked. And I like seeing this midday spike or early morning spike on my earnings winners after the initial spike. It shows that just because it's up doesn't mean that it's overvalued. More people are going to buy this. And then it dipped a little into the close and finished a little stronger here. And I was buying it on this dip. It couldn't break the day highs, but this is kind of a boring company. So I didn't really expect it to break the day highs. The question was the earnings, was the CEO commentary good enough to really spike the stock overnight? And I didn't know if it would. Again, I'm just playing the odds. And the fact that it closed near its highs, in the 930s, and I bought in the 920s and 930s, so I was up like 5 cents a share going into the close. Pre-market, I sold, or right at the open I sold. And I sold it right at 970, 980. And then I sold some here in the 10s. I had it in my short-term and long-term account. Both terribly timed. I panicked. I this is not my ideal kind of stock. I'm still emotionally involved thanks to the whole TheStreet.com fiasco with it. And I sold way too early. I profited, but I sold way too early, and that sucks. Are you noticing a theme yet? I've now shown you just a couple of my trades, but on all of them, I have sold too early. And the trades that I'm showing you, it's not like I'm showing you my best trades where I timed it perfectly. I'm showing you the biggest gimmies, where there is a very specific news, there's a very specific breakout, and these are the best charts to buy because I want you to model this in your head. Let me just show you a little bit more about VDSI here. You might be confused because I have a short-term and a long-term newsletter. And long-term, theoretically, you should hold it for several days or weeks. This is how freaked out I get when a stock goes up. I just forget my entire plans. I'm still working on my patience level with my longer-term newsletter. I did hold for longer gains in my longer-term newsletter, but just by like a few hours. I mean, it's a problem that I have, and you're going to have your own problems, okay? I hope that it's impatience. It's a problem that I'm very comfortable with, dispensing advice on because I can try and help you overcome the issues that I've dealt with. But there's all kinds of potential problems, personality problems that affect your trading. It's not just about buying good stocks or following the charts. When you're in a position and there's real money at stake, it's tough to keep a level head. Here is my $6,000 profit on VDSI. I said buying this earnings winner on a late afternoon dip after it got too ahead of itself earlier. Multi-year breakout over 9, so limited downside. Goal is to sell in the high 9s or low 10s tomorrow. Not a volatile stock, kind of like VTNR, which is also breaking out to 840 today, but no news there. Gotta buy earnings winners, technical breakouts. Already have long-term position. Goal on the short-term position is far less to sell into a morning spike tomorrow. And on my exit comments the very next morning, I said now up to 10-ish on analyst upgrades and $12 price target. I love it when a good trade comes together. This stuff is predictable, guys. Glad you saw it happen. Could go more, but I'm taking my solid profit and leaving. And this was a very good short-term trade. I made $6,000 mainly just because I bet pretty big. I bet $150,000 or $140,000. This is a very safe company. It's not a very volatile stock, but they did have good earnings and they closed right near their highs. And so I'm buying. Notice my position updates. We just updated this on Profitly now, which I think is very useful. You can see different commentary when I take partial positions. So at first I bought it at 3:24 p.m. Eastern. That's a usual time that I'm going to buy in the afternoon. That way it gives me nearly 40 minutes so I can see how it closes. So if I have a huge profit, let's say I buy it at 9:25 at 3:24 p.m. and somehow it breaks the new day high and then it goes to 9:70 going into like 4 p.m. Well, I would probably sell because then I'm making nearly 50 cents a share, and as much as I want to hold earnings winners overnight, I'm not sure about the risk. So if I have already nearly hit my goal and I don't have to take overnight risk, I'll probably take it. But it didn't go up that much. So with 5 minutes to go, I added 5,000 more shares at 9:37 just because it was closing strong, but it couldn't break out. And then the next morning, I guess we still have to fix the timestamps. I didn't sell at midnight, but it was right near the market open, and I sold it at 9:73, mainly just because this was a big position, and I specifically said in my entry, I said my goal is to sell in the high 9s or low 10s. So I got my high 9s, I got my goal, and I took it, and I made $6,000. Roughly 5% overnight. You don't have to bet 15,000 shares. You can buy 1,500 shares or even 500 shares and make 50 cents a share roughly, or 44 cents. But this is a good kind of trade, and you can do this over and over and over again during earnings season. Earnings season is 4 times per year, and there's also companies that just up their estimates in the middle of the quarter. They say, hey, business is going better. we're going to up our revenue and profit projections, and they'll put out a press release. And again, I don't look for earnings ahead of time. I learned the hard way from getting fired from TheStreet.com when I tried to predict ahead of time, and that sucked at the time, but it was a really great lesson. Let these companies report earnings first. You don't have to try and predict the earnings. That's a 50-50, coin flip. Instead, let the earnings winners come to you. And that way you're never at risk of, any bad earnings because the news is already out. Ideally, the conference call has already happened. And every quarter they do a conference call, or most companies do conference calls. Some companies just don't even do it. But the CEO and other executives can make comments on the conference call. So I don't like buying earnings winners that have reported earnings, but their conference calls haven't happened because there's still a potential chance for bad news. I want all the news to be out there, and I want people to be reacting to that news in a good way, thus making it an earnings winner. And you can still profit from the time inefficiency that it takes an analyst to review all the numbers and write up a research report. I think it was on April 24th. You can go back and look, but I think 2 different analysts upgraded VDSI that morning. And as you see, I mean, the run up from, I sold it right near the open in the 970s, within a few minutes it was in the 1030s, and, within a few days it was at 11. So I played it a little too safely, but I'll always play it too safely. And I didn't take the risk of the news. This was the gap up caused by the news itself, and this was the gap up just caused by latecomers buying it later on. And I love that later on kind of inefficiency because it's, I don't have to risk the news. All I have to do is understand, how Wall Street works and take advantage of it, because analysts, it takes time for them to go through all the numbers and write up a research report, usually about a day. So you'll have a lot of earnings winners that are upgraded the next day. With penny stocks and smaller companies, it's not a real-time thing. Like, if Google or GE or Priceline reports earnings, you have the biggest analysts in the world all covering them, and you'll get notes from those analysts within the first few minutes or within the first few hours. Very rarely will it be, a whole second. Yeah, I mean, there's no chance of really a second day upgrade. I mean, there's still a chance, but not as good of a chance on a second day upgrade when you're dealing with big companies. This is the power of inefficiency with penny stocks, and it happens again and again and again, and you just have to be prepared. Here is my longer term newsletter alert. I said I bought this earnings winner as it's breaking out. 10, 11, 12 are likely in the next few weeks. I didn't know how dead on I would be. But I got so freaked out. I locked in profits the next day. I did hold a little longer, to my credit. I made 7.5% instead of 5% overnight. But still, this was, I'm still learning to be more patient, and my long-term newsletter helps that. But when I get these 5, 7, 10% gains, I'm kind of like mechanical at this point, where I like locking in profits. So the long-term newsletter actually has helped me a little bit. I'll show you an example later on. Well, actually, I probably won't even show you because it was MAGS Security Systems. It was an earnings winner, but it didn't really bounce. Oh, I guess I will show it. It's a useful lesson. I didn't make any money on it short term, but I held it long term, and I held it for several weeks, and I made over 10% longer term. Earnings winners, it's not an exact science. You don't know 100% or even 80% or even 70% of the time if an analyst is going to upgrade the stock overnight, or if maybe some newsletter is going to write about it, or some journalist is going to write about it. But you have the odds on your side. When you're buying a company that's breaking out technically, that's so important on the chart, and you're buying a company that has positive new fundamental news, it's going to get more people interested than not. there are outliers where, sometimes an analyst can look at the numbers and be like, you know what, I don't care what the market says, I don't care how good the stock is, I'm going to downgrade it, and I'll show you that. The ticker is ACCO, and that kind of screwed up my short-term trade on that. But anyways, here are some tweets from VDSI, and that day I was tweeting it was up $1 a share. I love this one from RJ Fairchild. He said, I made $5,689 on VDSI pick. I subscribed less than a month and will now be a subscriber for life. Thank you. And he says, former Wolfpack. So he used to invest in marijuana stocks, and I converted him to actually buying good, solid, fundamental companies. And then R2 Row says, I banked from VDSI using the stuff I learned from Tim. I can't believe this stuff is so simple. It's unreal. Simple really does work best. A lot of my critics say, Tim, like you're trading these gimmies. It's like, duh, an earnings winner is going to rise. And I'm like, well, duh, there's thousands of different stocks out there, and you can buy them at all different times. There's no limit to when you can trade these things, and it's your fault if you want to ignore the simplest strategy. I can only show you what works best for me, and the simplest stuff works. And here's Jay Donut. He made $740 on VDSI. So, whether you make 700 or 500 or even 300 or 100, or let's say you're just watching, you still learn the pattern. And this will happen time and again. It doesn't matter the company. It doesn't matter the sector. Earnings, people buy in reaction to good, profitable, growing companies. Here's another one, Plug Power. This was their PR. Plug Power rose 61% to $1.27 at the close. Fourth quarter orders may reach 40 million, and the recurring revenue from service contracts will help it reach profitability, they said in a statement. So they actually didn't report earnings. They just, came out with this statement that, we have all of these fourth quarter orders, and that's awesome. And the stock gained 60% in a day. That's pretty crazy. And here is what happened afterwards. So this was, actually this is a better chart. Let me switch the order here. I bought it right here. This is the day of that press release. And you can see here it's in the dollar range. Within a few days it goes to $2. Within a few weeks it goes to $4. Within a few months it goes to $11. But it all started right here with that gap up. You can see that one green candle where it has space in between because the stock gapped up, and then the next day it gapped up. And here you can clearly see that this stock loves to abide by very simple technical support and resistance patterns. It's kind of a beautiful thing where it tries to break out, and then this was a follow-up breakout. I don't even think there was any news this time, so I didn't buy the secondary breakout when it broke out past this high. But you can see here, it went very nicely up within 4 days. This chart really isn't that good. But right here, you can see it. There's gaps in the chart because when the stock starts breaking out, you have all the buyers at the market open. And all the buyers at the market open means that the stock is going to surge at the market open, and everyone's all excited, and that pushes the price up. And so it doesn't, the price doesn't open at the closing price from the previous day. It goes up to a new high, and that creates gaps in the chart. And it's good to be long a stock when you have a gap up. If you remember my ISCO, LQMT had no gap up. It just actually went up in the middle of the day. What was the other trade? ISCO and why can't I even think? EKSO had the $1 a share gap up because of the Seeking Alpha article. So I like buying stocks with gap ups. Unfortunately, my patience problem really hurt me here with Plug. I was all excited. I bought the stock at 118. Remember, it closed at, what did they say it closed at? 127. So I bought the stock at 118 in the afternoon, but I didn't have the patience to hold. The problem was I took too big a position. 75,000 shares, it freaked me out. And this is a too liquid stock. There's tens of millions of shares trading, and it's going up and down. It's all choppy, and I'm like, I don't know what to do. And I got freaked out, and I took a $3,000 profit. Had I just held overnight, I think it went to like $1.50 overnight. So this would have been like a $20,000 profit. So I don't capture anywhere near the kind of profit potential that you should, but I'm still solidly profitable because I'm trading very reliable patterns and good news. It helps. So as I show you these trades, I hope you understand that, even though I've made several millions, I have left a lot on the table and I make different mistakes. On Plug, my mistake was buying too much. I got too excited. And, remember I say I like stocks that trade less than 10 million shares a day. Otherwise, they get too choppy. That is what happens with me. Um, I get freaked out, and there's no other word for it. In fact, as I'm filming this right now, I was just shorting this CUBA. This is a closed-end fund that is spiking way too much, and I shorted it right in here in the 1330s, and then I added, or actually in the 1320s, then I added in the 1340s, and I got my average of 1330. But you see here how it was choppy for, I don't know, what is this, 1:53 p.m. to like 2:30 p.m. So for 30 minutes, it was choppy, and I wasn't sure if this breakdown was the beginning of the end. Look how far it's come. It's come up from 7. And I know I haven't talked about short selling yet on this DVD, but I just want to show you a live example because I'm trying to trade and film, and it's freaking crazy. And, it was choppy for 30 minutes, and that was all it took. I got out. I, lost a little. I lost a few cents a share. And then, within 10 or 15 minutes of my cover, it cracked perfectly, and I'd be up, at 12.70, I'd be up like 65, 70 cents a share. I lost like 3 cents a share. So it's not that bad of a trade. It was a good trade, but this stock is way too choppy, and it's traded 10 million shares. So I don't like stocks that trade that much because even if they do go in my direction, I get freaked out. This is why I like less liquid stocks. I watch every single tick. I'm like a control freak. So Plug, yeah, I mean, fantastic that I made 3,000. I throw an annual conference in Vegas every year. I met this one guy, Sebastian, and he was the nicest guy. And he's like, Tim, I just got to say, I'm glad you brought up Plug. I talked about Plug in my presentation, and he's like, I'm glad you brought it up. I'm like, why? He's like, oh, I made $400,000 on that one, and my dad piggybacked my trade and made 85,000. So him and his dad made like $500,000. And had I just held a few more weeks or a few months, which I never would have done, but the potential for Plug, it went to double digits. So if I just buy the stock and someone knocks me unconscious, I'm up $800,000 at its peak. Now I'd be up. What is Plug at? I don't even know. I'm just looking for excuses to go back and watch Cuba. This is how addicted I am. I'm trying to finish this DVD in time for Christmas, and I can't help but trade and watch this stuff. What is it? Plug. I think it's down to the 5s. Whoa, is it back down to the 3s? Holy crap. I'd still be up 150,000, but you can see how Plug has come a long way down. And I was buying 75,000 shares right here on this green day on December 4th, 2013. So it's been over a year. December 4th, 2013, and then its high was March 11th. So roughly 3 months from 1 to the top was the 11th. Now back down to the 3s. So if you catch these earnings runners low enough, you don't really have to trade in and out as fast as I do. This is just me. Plug is great. So anyways, let me just talk quickly about what the terminology is, because I know I'm throwing around terminology, and I'm trying something different with this DVD where I'm trying to just talk to you kind of like a conversation, and in conversation, things come up. So earnings per share is EPS. This is what an earnings winner is all about. Companies are meant to be profitable. As I talked about earlier, some companies, a lot of internet companies, are not profitable. Their whole goal is just to get as many users as possible and not burn through all their cash. And that's a very risky game when you have a startup and they're trying to grow and trying to get market share, and they're burning through their venture capitalists, and they're burning through their investors, and the whole goal is to try and get big enough so that you have some kind of competitive advantage before you go bankrupt. And most startups don't manage that equation very well. So earnings per share is pretty much what every big S&P 500 company has. But I don't really trade the S&P 500. These are the big companies because they're fairly locked in value. They already have existing businesses. Every now and then, you'll see an S&P 500 stock or a Dow stock that goes up 50 or 100% per year, but not 50 or 100% in a day like the stocks that we trade do. So earnings per share are calculated by dividing the dollar amount of earnings by the share price and the number of shares. It doesn't really matter exactly what the calculations are. It's just a question of analyst estimates, because this is the thing with earnings. You might have like a great quarter with blowout earnings, like earnings are up 100% year over year. This is amazing. But if the analysts already expected it, the stock doesn't budge. And people email me, they're like, Tim, the earnings are fantastic. Why is it not moving? It's not your job to figure out why the stock isn't moving, okay? It's built-in expectation. Sometimes you have blowout numbers and the stock drops. And people are like, oh, the stock market is so hard. Yes, the stock market is hard if you ignore the rules, just like driving is hard if you ignore stop signs. You also have revenue. That is the amount of sales that a company brings in. Profit margin is revenues minus the costs of delivering those revenues. So you have ideally a profit. And then you divide these earnings every quarter. So you have 4 quarterly reports per year. And there's a thing called earnings season. And that's when all the companies report all within the same few days and the same few weeks. So you'll have earnings winners like every day for a few weeks. Sometimes there aren't any earnings winners when there's no real big blowout numbers that weren't already expected. It's all about expectations. So you can't expect any company to be an earnings winner because you just don't know. It's all about how they perform versus expectations, not just how they perform. You can't go and waste time and do a guessing game research where you're like, oh, I've checked with all the retailers of this technology company and sales are supposed to be strong. Well, but you've done that and every other analyst has done that. So it's probably already priced in. So don't try and guess earnings ahead of time. Wait and see. Then you have beat estimates and missed estimates. You'll hear me and analysts and CNBC say, it's just a question, did the company beat the analysts' estimates or did they miss it? And did they guide up or guide down? Because you have past earnings that the company is reporting, like the company reports earnings for the past 90 days, the past quarter, and then they also have expectations for future quarters. And if, let's say, sales are really strong, they can say, hey, earnings are going to be stronger than expected in the next quarter, so we're guiding up our revenue numbers or we're guiding up our profit expectations. So analysts have expectations and companies have expectations. And this is very key. Almost every company does an earnings conference call where these analysts and hedge fund managers and investors can ask questions. So a lot of the time, sometimes, or whenever really, there's no real ratio of what companies do versus what they don't. But sometimes companies will report very bad numbers and then say very good things on their earnings conference call. Say, oh, this quarter was bad, but we're working on a new product and the reception, our customers say they just love it. So then the stock will spike and people will look at the headline numbers and they're like, why is the stock spiking? There's terrible numbers. And it's because of something they said on the earnings conference call. Or maybe, they'll report good earnings and the numbers will look great and the stock will drop and people will be like, why is it dropping? The numbers were great. And it's because maybe it has been great in the past, but now maybe there's a new competitor and the new competitor is taking away business in the future. So they'll say that on their earnings conference call when the hedge funds and analysts are asking questions. So all of this stuff is a guessing game. This is why analysts are right less than 50% of the time. This is why professional money managers don't make money. This is why I'm trying to get you not to play this game. There's no way to win, okay, consistently. You can win every now and then. You might beat the odds, but eventually the odds catch up to you. This is casino business 101, and it's stock market 101, and it's stock trading 101. And unfortunately, People love playing guessing games. Everybody likes to know, oh, Tim, I know you only wait for the news afterwards, but what do you think about this company? They're reporting earnings tomorrow. I think it's going to be great. No buts, okay? Do not play a game you cannot win. It will not make you rich. I'm sorry to go against all of Wall Street and what brokers want you to do, because brokers just make money off the commissions. But I don't make money off your commissions. I don't want to make money off your commissions. I want you to get rich and make me look good. And that means sticking to games that you can win. Analysts upgrades, analyst downgrades, analyst price target upward revision, and analyst price target downward revision. These are predictable because analysts are human beings and they all think alike and they all act alike. So when a company reports earnings, an analyst, and most analysts, come out with a report the next day or the next night, sometimes even 2 nights, because they need time to look at all the numbers, go through their notes, write up a new report, print out the report, send their report to their company, and then their company sends their report to all their customers and says, hey, Analyst Dave has a new report on company XYZ. And when the analyst upgrades a stock from, they have different ratings, so they can rate it a sell or a hold or a buy or a strong buy. So if an analyst likes an earnings report, he might upgrade it from a hold to a buy. And he might up his price target from, let's say, $5 to $7. So that's when there's good news, and that's when the analyst is reacting well to earnings, because whatever the company said or did, it exceeded his estimates, and now he has to adjust his forward estimates. Or sometimes companies can let down analysts, and then the analyst will downgrade the stock, and the analyst might say, hey, this stock used to be a buy, but this quarter, new competitor, I really don't like it. I'm going to downgrade it from a buy to a sell. And the price target goes from $10 a share down to $5 a share. I'm not interested in so much as to what the analyst says, what the price target is, what the upgrade or downgrade is. I don't care about the numbers. I care about the trend change. When an analyst upgrades a stock, and you know that that firm that analyst works for is going to send out this upgrade to all their customers, and all their customers love speculating on new ideas, that means that all of that firm's customers are going to probably buy the stock. And that's going to have a positive influence on the stock price. So if you can find a company that has reported, let's say, good numbers or decent numbers, said good things on the earnings conference call, and ideally the stock is breaking out intraday or breaking out over a multi-month high, then you can have pretty good odds that an analyst is going to say something good the next day. And that's what happened with VDSI. And this is all predictable without having to guess the news, if you understand how Wall Street works and how analysts works. So don't try to guess earnings ahead of time. Wait to see if the company reports solid numbers and ideally guides future numbers up. If the company internally is going to guide their numbers up and they're going to say, hey, we expected to do revenues of 20 million next quarter, and because of good business, we're going to probably pull in 22 million or 23 million. So they guide up. If they internally guide up their numbers, odds are the analysts are going to have to guide up their numbers. And if you have some lazy analyst who doesn't guide up their numbers right away, odds are he's going to guide up his numbers in the next day. And then all of that firm, whatever analyst, that firm he works for, the next day all of that firm's people, customers, are going to buy. So you don't have to try to guess a reaction to earnings ahead of time. Wait to see the biggest stock percent winners. Everybody always asks me, Tim, what news sources should I try? How do I find companies that are reporting earnings soon? I don't play any of that game, and I have a much easier life as a result. All you have to do is look for big percent gainers, and ideally during earnings season, and ideally the analysts haven't upgraded all. Sometimes the analysts upgrade it the same day, and then if all the analysts upgrade the stock, then that's already priced in, and it's tougher to play. I like it when a stock reports really good numbers, and then Wall Street is kind of slow to respond, and then they're like, oh, these numbers are good the next day or the next night, or maybe sometimes even 2 or 3 days later. It's not an exact science, but do not have positions in earning stocks before a conference call is about to begin. Again, they can say anything on the conference call, positive or negative. It's a complete guessing game. And don't just focus on the headline numbers like the news does. Consider management commentary. I don't want you to guess numbers. I don't want you to guess commentary. I want to teach you to learn how to play the reaction to numbers, the reaction to commentary, because that's lower risk and it's more predictable. This is the secret to my success. I try to take all of the guesswork out that almost every single person on Wall Street and most traders think you need to do. They think that you need to guess which companies are going to be earnings winners ahead of time. They think that you have to guess which companies are going to win big contracts ahead of time. And to get truly rich, you just don't have to. You just have to learn how to play the reaction. By waiting for the numbers to come out, you reduce your risk. By waiting for a spike in reaction to earnings, you don't have to guess which stocks will be earnings winners. Some days there will be no earnings winners. It is not the end of the world. Go outside, go live, go work out, go hang out with friends and family. When there is the right kind of play, ideally that you'll see in the next few examples, then you have to not work out. You have to push your family and friends aside and you say, hey, I've got a really good play here. The odds are on my side this time. I'm a sniper, okay? Don't make the whole sniper analogy because that just might freak people out. But you have to think like a sniper. An earnings winner is defined by me to be the reaction to earnings, not the numbers themselves. Too many people make this mistake and they try and trade based on the numbers and they say, hey, this company has good numbers, let me buy it. And then the stock is unchanged for the day. And they're like, I don't understand trading because I don't care about stocks that don't move. I want everyone to be amazed and shocked by the numbers and upgrading the stock. And if they don't upgrade the stock today, then they should be upgrading the stock tomorrow. And anybody who looks at the numbers should just be like, wow, this company is undervalued. I want to buy it. And for me, I want to be long before those other people get there because I know I'm a harder worker. And even though I don't have to guess the earnings ahead of time, I do want to be there on day one whenever the company does spike in reaction to earnings. Analyst upgrades. Follow-up news articles usually happen overnight the trading day after earnings are announced. And as I've said a few times, and I'm going to say it 50 more times, sometimes earnings winners spike on day 3, day 4, day 5, sometimes even day 7 after earnings. It's not an exact science. If it was an exact science, I'd be a billionaire. But the odds can be on your side, which is good. Earnings winners that break above multi-day or ideally multi-month support are best. And dip buy winners, earnings winners, if they hold above that key technical support. Cut losses on earnings winners that fail to hold the breakout support level. So even if you're trading the stock, even if you're like, okay, Tim, the reaction to earnings is good, the comments were good, I think an analyst is going to upgrade the stock tomorrow. To be safe, you really have to look at past levels that the stock has been, trying to break out of or, successfully breaking out of and see if that technical resistance or technical support holds. Because then you have kind of a two-pronged attack where you have the fundamental news on your side and you have the technical news on your side. And you want both. I know there are traders out there who don't care about the news and some people don't care about the charts. I care about both of them. I want all the indicators on my side. I want all my ducks in a row to give me the best odds of success on every trade. And if somehow, let's say I buy a stock that for the past year couldn't break above $5 a share, and now on the earnings it's at $5.10 or $5.15, and I'm like, wow, that's a multi-year breakout, good earnings, I'm buying. And then it drops to like $4.90. I get out, I cut losses. It could not hold the breakout. And I am not going to support a stock that cannot hold the breakout. And sometimes a stock, in this theoretical example, if it breaks past $5 a share and you're buying it at $5.10 a share, so just slightly above the former resistance, and now $5 a share should act as support. And sometimes the market makers will just drop it to $4.90 for a few minutes and then place it back at $5.10. Sometimes I psych myself out by playing it too safely. But I'd rather play it too safely than risk a big loss, and if it is a failed breakout, as we saw earlier in this DVD, then maybe it goes to $4.50 a share. And instead of losing 10 or 15 cents a share, you're going to lose 50 or 60 cents a share. Those bigger losses will come and bite you. And remember, I don't want big losses, especially if you're on this $1 million trajectory and you're only trying to make a few hundred here, a few thousand there. Sometimes you get $5,000 or $10,000 on a profit, but if you have a $3,000 or $5,000 loss, that's really going to hurt your trajectory and your confidence. Do not underestimate your confidence. Big losses will crush you. If you guys watch sports, it's amazing how a good start in a football game will really get the confidence of the players all going, or NBA or baseball, whatever sport you have when they see that they can succeed against another team, it makes them do better. It doesn't, they're not better or worse physically speaking. They're all professional athletes, and their skills don't get better during the game time. It's just a question of confidence, and they perform better when they're more confident. It's very tough to come back from like a 49-0 game in football because you just feel terrible about it, and you don't think that that kind of a comeback is possible. There are some great comebacks, but it's just tough to really believe in miracles because you don't see that every day. Versus if you cut losses, when an earnings winner or any other kind of stock for that matter fails to hold a key level, you protect yourself and you protect your confidence. And also understand that sometimes earnings winners spike on future days. By understanding this, sometimes you buy the stock on day 1 or day 2 after the earnings are announced, and it does nothing, and you're like, I'm bummed. And then it spikes 3 days later. You don't, or you shouldn't feel guilty. I know that you do because I'm in that position right now, actually. And I know that you want to feel guilty, but it should just validate your approach. Whenever a stock moves in your direction, even though I just screwed up my Cuba short, I was right. Okay, the stock dropped. Let's see what it's at now. 1286, 1290. Okay, so it dropped a little bit. But this is my kind of shorting pattern. And I was right to short it in here. It was just a little too choppy. So I was on the right track. So I don't really regret that trade. I don't regret losing a little bit of money because, frankly, I was right. And it helps. And you'll see this in person. Right now, I'm sure some of you guys are skeptical. You're like, does Tim really do this? Well, you'll see it for yourself. This is why I love my haters, because you can hate on this strategy, you can hate on me, but you'll see it in person again and again and again, more times than not. And it doesn't work 100% of the time, but 6, 7, sometimes 8 times out of 10, it will work. Also, this is very important. Ignore companies that have no reaction to earnings. Ignore earnings losers. So many people get into this, just messed up mindset where you see a stock and you've read the numbers and you've read the commentary and you think that you know something that Wall Street doesn't. And you're like, you know what, this stock is unchanged, but the numbers are really good. I think that Wall Street is going to recognize that soon. And sometimes you're right, and it serves as a bad lesson. I don't want you to be smarter than Wall Street. I don't want you to be first to discovering some kind of news. I don't want to, work that hard and dig that hard. I know you might be proud of yourself for figuring something out that no one else knows, but that's not going to serve you well in the future. To be the best at this kind of a strategy means to piggyback the best. Are you the best piggybacker? Never ever trade a stock that has no reaction to earnings. Okay? And for that matter, ignore all stocks that are unchanged on the day, because you need to utilize the stock and the stock price and the stock volatility to grow your account. Stocks that are unchanged on the day, that ain't going to grow your account anytime soon. So you can analyze the numbers, you can analyze the profit margins of the industry all you want. But for me, I'm interested in one thing, growing my account, but I'm interested in you growing your account. So ignore stocks that are unchanged and ignore the daily big percent losers. Stocks that are down 20, 30, 50%. I know that it's weird that I only focus on the biggest winners, but the biggest winners are more predictable. When you have a stock that's down a lot, it becomes a very different company. Again, all because of expectations. Everyone has different expectations. Some people, when they're down 30% on a stock, they're going to double up and they're going to be like, you know what, I still believe in this company, I'm going to add. And maybe a lot of people will think that, and the stock will bounce. from down 30% to maybe down 20% on the day. But then you have a lot of other people who are like, oh, down 30%, I don't trust this company anymore. Let me just cut losses and get out. And you have no way of telling what those people will do and how many of each category there will be. By focusing on the biggest percent winners, by simplifying it to saying, will the analysts upgrade it? Are the numbers good enough, the reaction to the numbers telling enough that someone is going to write positive things or an analyst is going to say something positive overnight? That's easy to understand, okay? It's not an exact science, I have to say that, but you have the odds on your side versus total guess it work when you're dealing with stocks that are dropping a lot or unchanged on the day. So let me show you a few examples. Enough of me blabbering. Here is Facebook, actually. Earnings winners are not just penny stocks. This is kind of a little bonus for those of you who thought that I only trade small stocks. Facebook, I wouldn't buy it now considering the stock is at 80, but back last year in July, Facebook was up $4 a share to $30 a share in after-hours trading. And they posted earnings per share of 19 cents a share and 1.81 billion in revenue. And they were only supposed to earn 14 cents a share on revenue of 1.62 billion. So this is where they beat estimates. They beat estimates by nearly $200 million, which is not a little thing. And they beat earnings estimates from 14 cents to 19 cents. All in all, this is a good report. More importantly, they soar on growth in mobile. Okay? You don't want a company just to beat on revenue or profits because they're, really good at cost cutting. Cost cutting can only go so far until, you've cut out all your costs. But on an unlimited sector like mobile internet growth, then the sky is the limit. And that is really what blew up Facebook. And so this is the chart. This is a daily chart for 100 days back when I actually bought Facebook. You can see this gap up. This gap in the chart is when they reported such great growth numbers and mobile numbers, and everyone was just like, wow, this is amazing. So it trades after hours at these prices in between 27 and 33. And that article was written at night. I think that was from Barron's or New York Times or something. Everybody knows Facebook. So you don't have like the whole analyst upgrade thing the next day. But still, that article, what was it? It was at 4:11. Oh, this was Forbes. It was right when they reported earnings, and the stock was up 15% at $30.50 a share. It opened the next day at 33, so nearly $2 a share above where it already spiked to after hours. And that was because on their earnings conference call, they were saying, look, we are growing really fast. Our mobile growth is amazing. And that is really what spiked the stock, and that's why I bought the stock pre-market. And here's what Facebook has done since. You can see the little gap up, and sure enough, they've been riding the wave of mobile growth ever since. They have yet to have a bigger move or a bigger volume day than this day when they had that blowout earnings. And that's a really good sign when a big company reports blowout earnings. Now, normally I don't buy big companies, but because this was such a perfect choice, I bought it in both my short-term and long-term accounts. And I bought it big in my short-term account. I was so excited about this. I bought 6,000 shares, nearly 200,000 bucks, and I just couldn't do it. I made 840 bucks. My exit comments, I was like, I can't do it. It's just too choppy with a huge wall at 34. Wait for my video lesson. And then by the time I even typed this out, it said already 34.08 as I typed this. Oh well, and I made 2,000 overall on some other stock. So I basically called the beginning of this huge run-up, but it wasn't my exact kind of a stock. I'm not good with stocks that trade that much. I'm not good with choppy stocks. In my long-term account, I actually held it. I had a very small position, just 500 shares, and I held it for a few days. And I made over $2 a share, so 7%, which was kind of fun. I'm just not good at long-term. I'm trying. This was 5 days, which is an eternity for me. But had I just been holding it now, I'd be up 50 bucks a share, which would be cool. But that's never going to happen. So, you deal with it. So why am I buying a stock like Facebook that's so far out from what I normally do? Well, I like the earnings. I like mobile growth. I like the big reaction to earnings. But most importantly, it's a chart breakout. Look at this. You see this gap? This is where we're talking about. The former high right here was around 32. And the former high right here was around 32. So when it's at 33, it's a breakout. It's a technical breakout. That's how simple it is. You can draw a perfect horizontal line across here, and with the good earnings and with the good news, it broke the previous highs. Obviously, on the first day of the IPO, it was a little higher, but I care about these highs also. And this started a whole new just valuation for Facebook. So when it took out this double top and it was on good earnings, I had a news breakout, I had an earnings breakout, and I had a technical breakout. The trifecta, baby. So this really is my secret sauce. Instead of just buying, random stocks at random times, or sometimes, people just buy breakouts because they're like, look, the stock is breaking out. I need a breakout and I need the right news. And I would never trade a stock like Facebook in a million years, but thinking like myself as a retired trader, and I'm only going to get back in the game if there's a play that I would feel so guilty about missing that I literally have to get back in. And that's what happened here with Facebook. I knew that this wasn't a penny stock. I knew that it wouldn't really go up that much, but I just knew the odds were so good that I would make money. I could not ignore it. When you have a really bad performing stock like this, surprisingly bad, and you have this double top, and now it is just above that double top, the indicators, the odds are just so good, I cannot ignore it. And even though I mistimed my short-term trade, I mistimed my long-term trade, I profited on both. And had I held a little longer, there would have been bigger profits. But this is the kind of trade you wait for. And not since this big gap up in this amazing earnings report has Facebook, it's been uptrending, but it's never had such a huge run up in one day like it did that day. And that's when I like to play it. When these stocks, no matter what they are, mostly penny stocks, but every now and then a higher price stock, has the potential to really make a big move. So let me show you another chart. This is ACCO. They are into office supplies, an industry I never would want to trade except for the fact that they had a beautiful earnings report and they were above this previous high here right at $8 a share. So it was screaming to me to buy it. It actually went up to 870. I missed the first run up because it opened at around 8 and it went to 870. And then I was dip buying it in here in the 830s because I'm like, well, this is probably going to go back to 870. And the problem with this trade is that I wasn't at the support level. I bought it at 830-ish and I'm 30 cents a share above where it should have technical support, where, it would be a safe trade. And I went big because it was off of its highs of 870, but I was kind of in no man's land here, mid-range. The high is 870, the low is 798-ish, so I'm 40 cents a share off the high and the low, and that's kind of rough. And I got out because, frankly, I just wasn't sure what it was going to do. And fortunately, I played it safe mainly just because I had such a terrible execution. And sure enough, the next day, I had no position overnight, but the next day, we actually got a downgrade at 7:20 in the morning. ACCO Brands downgraded from hold to buy. And this happens sometimes. And if you're asking about which news sources do I use, I'll have a whole list of websites at the end of this. But first, I want to teach you the patterns. But this, KeyBank downgraded ACCO to hold based on balanced risk reward following yesterday's strong move. And this, I wish I could just smack this analyst silly because, his downgrade the next day created this one red day and everyone thought that it was topping and it wasn't going to hold this breakout. And then what did it do? Just kept going up. And, each one of these candles represents one day. So it took a whole month to go from, $8 to $9 a share. So it wasn't a big move. But this downgrade screwed everything up because it did hold support here at 798-ish, but I wasn't going to buy a stock that got downgraded. Like I was like, what am I not seeing? What am I missing? So I didn't rebuy this even though I should have. And, actually 2 days later from 790 to 840, you had a nice 50 cents a share run up. Nothing huge, but, when an analyst downgrades a stock that's up a lot, it kind of sucks out the momentum. Here's my trade. I lost $400. I was trying to go in and out. Like I sold some, I bought some here in the 840s, then I added at 839, then I added a lot at 828, then I sold some at 838, and then I sold the rest at 817 when it just wasn't going in my direction. And, it's good that I didn't wait overnight, because had I held overnight, I probably would have gotten out at 8 or 790. But it was just a weird play. But that's an office supply play. So I want to show you when an earnings winner doesn't work out. Even if the earnings winner does go up eventually, it might not move up right on day one or day two. Here's another example, MNDO. I actually made money on this. I was watching it here. You can see the gap up and the volume spike right here on November 3rd. They reported earnings, and everyone thought that this was going to be a breakout, but it couldn't hold the 340 level, or 335 was the breakout, and it finished in the 320s, and that was very disappointing, and it dropped for the next few days. But then, what is this? So this was day one, day two, day three, day four, day five. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. Day 12 after earnings was the big breakout day, which is so strange. But, sometimes it happens. You couldn't get the technical breakout here. And it was still range bound. You can see here it tried to bounce again and then it failed. So every time it can't break the previous high, it drops, because people are like, whoa, I guess that's the ceiling. And then all it took was one day here to really break out, and I nailed it. I said dip bought this earnings winner we talked about is down 25 cents a share off the morning high. So it had already broken out. This is what I'm saying. I don't want to create a breakout. I like the fact that it was already up when I bought it, and I'm buying it, near technical support now. So I'm buying the stock at 348 after it had already touched 370 that day. So this was already going to be a breakout above this previous day. The only question was, would it hold it or would it fail? And I bought it close enough in the afternoon that I thought that it was going to spike back up. And sure enough, it did. It went actually to 380 the next day, then it dropped. And then, a few days later, it was up to 420. But I was in and out. I dip bought it near support. And I just wanted it to hold above 350. And then I thought if it could hold 350, it would give me 20 to 40 cents a share of upside. And then I said big seller at 365 scared me out. Now 370, so my fears were unfounded. So I sold a little too early, and then within a few days, it's in the fours. So you'll see this, the difference between me playing it too early on this one versus me playing it too early on ISCO. It's the same exact thing. ISCO, I made, $100,000 plus, and I made 50%. On this one, I made 5% in just a few thousand. But it's the same kind of philosophy where you go in with a thesis on a trade. You think that it's going to break out, and how far can it break out? You don't know, but you go in with a thesis. If something freaks you out, you get out. And on this one, I made 5%. On ISCO, I made 55%. But this one was also kind of weird because it didn't have the news right away. ISCO announced they were going to be on TV. So I like news that will be meaningful. If MNDO had reported earnings on the day that I was buying it instead of 12 days prior, I probably would have held overnight. But it was a weird 12th day breakout on an earnings winner. I'm not used to that. So anything out of the ordinary I'm not used to, and I get freaked out and I play it extra safe. I still made 5%. And then everybody else, all those students, banked because they held a little longer and it went up even more. So I like when I don't make the most. I am not happy when I make money and my students and subscribers don't make money. That's useless to me. Here's another tricky one, and you can see how tricky it is by this choppy candle. Obviously, it's in this uptrend. This is a 100-day chart of Maggle Security, MAGS. You see the big gap up here and the big volume spike. So it traded its biggest volume day in years. But it kind of double topped right here. You can see back in September, it topped here at just over 6, and then here on this earnings report, it topped just over 6. And I was trying to dip buy it in here, and I couldn't make money short term. But I also bought it long term in my long term newsletter, and I got my average to the 520s in this whole choppiness. And I was like, you know what? This stock has broken out. Look at this previous high going back to last year. The previous high was like 510, 510. This high was like 5. So by buying it here at like 520, and yes, it did get down to 510, but by buying it towards the end of the bottom of its range, I thought that it could get back up. And it did. It went back up to 6, not for the reasons that I thought, but because they're a security company, and there were some police controversies, so all security companies were spiking, and that's actually what made me sell it. But it's kind of funny that I did better on my long-term trade here just because this stock is so choppy. So I said this security company reported blowout earnings today and already hit 630, so I'm buying on a sizable dip. It is a multi-year breakout above $5 a share, so there's not much risk, and their new next-generation products like RoboGuard has zero competitors. I can picture robots guarding facilities, and they should announce contracts for it in the coming weeks and months. My goal is to make 20 to 40% on this stock over that time. And I sold a little too soon, or I sold, actually not too soon, I sold a little sooner than I thought, but I took a 10% gain because it went up on the whole Ferguson police shooting debate, press hype, and it's not really due to the company. I mean, they make this RoboGuard solution, so yeah, it's into security, but it's up really for the wrong reasons. And sometimes that happens where, you're going to be in a stock long or short, and the stock will do kind of what you want or exactly what you want for the wrong reasons. And, don't look that in the mouth. I mean, take that gift, like whatever. So this was a kind of a pain in the ass. I initially bought it at 540 and then I added at 497. And even though it did not hold support at 510, the sellers here on this day on November 24th, it was kind of like very light volume holiday selling. So again, this is not an exact science. Normally, if a stock cracks $5 a share, you're like, uh-oh, support was taken out, I need to get out. But instead, I added to my position because I thought this was just a really good price to get in, because I thought that the sellers, it was just a few sellers, and it was probably because most of the traders were taking the week off due to Thanksgiving. So there are one-time events like that. And I added to my long-term position, and I got my average to 518 on 6,000 shares, so roughly $30,000 investment. And then I sold some a few days later at 550 into the nice holiday spike, and then I sold some more at 577. It actually went to 6, so I didn't time my sells perfectly, but I still made 8%. And this is what I want to teach you, where you don't have to be perfect. And if you can make 5 or 8%, yeah, it sucks. It's not going to make you rich anytime soon, but you're going to learn to develop how to trade. Making 8% on a stock like this, where you're watching the developments and you're seeing, oh, should I add to this position? Should I sell into this spike that's caused by something totally unrelated? And the answer in both cases was yes. This taught me a lot, and that's why I'm using it as an example. So if you can make 8% on a trade and it teaches you a lot, that's better than a trade where you make 10 or 20% on a trade and it teaches you nothing. You really have to think of a small account when you're first beginning as just an educational tool. Your account is something that you're playing with, and yes, it feels nice to try and grow it, but you really have to, buff up your education before you buff up your account size. Because if you just get rich with no education, you're probably just going to lose it. And that's not good. I want to try and really help your education develop before you make a lot of money. And as your education develops, it'll enable you to make a lot of money later on. Here is BDR. This is a stock I did not trade, and I kind of wish I did. This was the earnings breakout. You can see the clear gap. So it was already up on the day from the 120s up to the 170s. And here was the previous high here in the 170, 180 region from a few months prior. But I did not buy this because, I just wasn't sure it had enough juice to break out past 180. And for the second day, you see an entire second day, it was red. No analysts upgraded the stock. I don't even think analysts cover this company. It's such a small company trading under $2 a share. But then on the third day, you had the huge breakout. And I had an opportunity to buy, and I hesitated when it was breaking out past this 190 level. That's the time to buy on day 3. And 190 to 240, 50 cents a share, 20% on your money. Is that what that is? Let me do some math. Let's say I bought it at 190. Yeah, 0.5 divided by 1.9. So you make 26% on your money buying the breakout. And this is a breakout over this previous day and a breakout over this previous month. And you can see actually the third day, even though there's no news on that day, is the huge volume spike. It's kind of funny. This is how I know that my pattern really works. A, I didn't trade it at all, so it's not me buying it and pushing it up. And B, there's more volume when the news is already out 2 days prior. Kind of interesting, huh? Right? So this helps you understand that it's not just about the news, it's the reaction. And when you can have a breakout over, this would be a 2-day breakout at 190 and like a 3-month breakout here above 185, 190. There's not even like one exact time. It's, you have to try and judge, like, can it break 180? Can it break 190? And with the strong volume, it could. And, you make 26% by the end. It didn't finish at its highs. And then the next few days it had to actually consolidate. And then it went up even more. But, you have a 20, 25% gain on this with very little risk because it's an earnings technical breakout. So if you were to apply risk reward to a possible trade here on BDR, yes, it's easy now in hindsight, but let's say you're watching for this breakout on day 2, there's no dice. Day 3, you get the breakout here. Let's say you have a very small account and you buy, let's say you have a $5,000 account and you buy 1,000 shares of this stock here at 190. So you're using nearly 40% of your account, and your goal should be, on a breakout here over this stock. I mean, on the big breakout day, it went from 130 to 180, actually 190-ish. But this was on earnings themselves. So you can't really expect it to spike 60 cents a share. I don't even think I would have expected it to go to 240. If I was buying it at 190, I probably would have put my sell at like 210, 215, maybe 220 at the max. And if you're buying a thousand shares here, you sell at 220, you make $300 on $1,900 trade. I know it's not a lot, but it helps get you bigger. And when you take your account to a bigger size, you can bet bigger. And there's no difference between buying 1,000 shares here at $1.90 or 10,000 shares. And if you buy 10,000 shares here at $1.90 and you sell the same 10,000 shares at 220, now you're making a pretty good living, $3,000 in a day. And you don't obviously necessarily have to sell same day. The next 3 days would have been consolidation, but then the next 3 days it went all the way up to 280. So you actually, if you want to hold for a week and swing trade it, you might make $800 on a $1,900 investment. That's kind of the cool thing about buying earnings breakouts. They can just keep going. But you always do have to be careful. Sometimes they don't go as planned. And I want to show you failed earnings breakouts. This was Zag. This was my big pick over the weekend. I made a video. I was like, this is perfect. Here was the gap up. So it's already an earnings winner. This is very important. The stock has already proven itself to have doubled. If you read the press release, they actually doubled their profit estimates and they guided up their revenues and their profit margins. And this company makes, little screen protectors for iPhones and iPads. So it's not really that exciting of a company, but it has been a runner in the past. And if you look back at these companies and you look back, a year or 2 years, 3 years, and you see, hey, this stock actually, spiked exponentially before, that's a good sign, rather than like an office equipment stock like ACCO. Former runners, stocks that have spiked a ton, can run some more. So here is ZAGG. It opened at 6 and it went to like 630 and then it was kind of downtrending. I bought right here on the dip. I tried to get it here in the 590s when it dropped for a quick second, but I couldn't get executed. Then it was kind of bottoming here right near the morning low at 6. And as you'll see in a second, $6 a share is a rather important technical level. So I thought that it was going to bounce here at 6. It did. And then I stupidly, the mistake I made was that I thought that it would break out past 630 pretty aggressively. So I added big to my position size here at 618 right into the market close right here. And, it closed at 620. And the big question was, could it break 620? It had trouble breaking 620 in the middle of the day. And 620 is where multi-month resistance was. And the next morning, no analyst upgrades, unfortunately, no new articles. And it dropped a little to 605. I tried to add to my position, couldn't get added. And it went to 640. But I was selling in the 620s because it just looked weak. It was just disappointing. So I made like 5 or 10 cents a share. Later it went to 640 in the middle of the day. So at best I could have made like 20, 30 cents a share. And I locked in, like 5 or 10 cents a share. This did not go according to plan. Here is the chart. You can clearly see the gap up, but you see it also like finished red right here. on the second day because it just wasn't closing higher, and it needed to take out 620, 620, 620. So it was a perfect triple top. Obviously, you had this one breakout, but aside from that one breakout, you had a triple top here at 620. And you ask, why did the stock get crushed here? It was because they actually said sales were going to slow down. And then over the course of November and December, now they're saying, guess what? Sales are good again. So let's increase the guidance. So I thought that it could at least get above 620, maybe to the 630, 640, 650, 660s. I had no intention of thinking that this is like ISCO or EKSO where it could go up $1 a share. I just thought that if it broke 620, I could get out 630, 640, 650. So my goal was to make like 50 cents a share on my initial buy. And the key was that it had to break 620. You can draw a little horizontal line pretty much, across this triple top. And you can see that it did, 2 days in a row break 620, but it just could never hold it. And that's not a good sign. So I got out. And then today, actually, when I just added this slide because I thought it was funny, because right as I was filming this video, I was like, well, some stocks, they just can't hold support or they just can't hold resistance. They failed to break out no matter how good the numbers are. And then today it goes up to 660. So it wasn't on day one of the earnings. It wasn't on day two after the earnings. It was on day three that this stock had a big breakout. So I was off by one day. Kind of funny though. This pattern never ceases to amaze me. Even when I mistime it, even when I think that, well, this is the time, you're wrong. It was bound to happen. Somehow these stocks always find a way to break out either on day 2, day 3, day 4, day 5. ACCO got downgraded and it kept going. MNDO broke out on day 12 after earnings. Never underestimate a stock that spikes in reaction to earnings. They said something good on the conference call. They said something good with their numbers, and that leads to a higher valuation for the company, even if it doesn't happen at the exact moment that you want it to. So ZAG hit a high of 660. I think as I'm filming this, it's down to like 650. But I had a pretty good position size. I ended up making $1,500, but I went pretty big. My good buy was right here, 5,700 shares at 602, and that was buying this earnings winner right near technical support. It wasn't at 620, so it wasn't like at the breakout level, which is why I just bought a very small position. But then I made the mistake of really going bigger at 618, expecting that the 620 level would break. And while it did, it just wasn't in a very convincing way. And that was my bad for getting so aggressive at a key level. It's okay to buy on a dip because this way, even if it fails at 620 and you're in at 602, you can still sell at 615, 610, 607. And that way you don't have to guess whether it's going to be a breakout. If you buy right just under the breakout level, that breakout level better happen or else you're going to have a loss. And for me, right as I sold it, I sold it in a few blocks. Right as I was selling and began typing it, it went up to 644, and I was like, I wanted to wring its neck. It was just so frustrating. But this is a very typical timing pattern that I would do, where I didn't want to actually buy it here at 2:30 p.m. I like buying at like 3:15, 3:30 p.m. because then you have safety with the stock market close. And I expected someone to write about this or get an analyst upgrade overnight. But I bought it at 2:30 p.m. a little earlier than I'm used to because the price was right. I didn't know if it would hold the bounce or not. And sure enough, it was a good price to get in at. I still made money on my second entry because I got in at 618, and overall I sold at 626. But when you go big like that, you want to make more than 8 cents a share. I mean, that's just weak to make $1,500 when you're betting 120,000. So this is an example of a big trade that I would make where I bet $100,000, but you can easily just buy 1,000 shares here at 602, or 500 shares if you want, and sell it anywhere, 620. If you want to say, hey, it's not breaking 620, and you make 20 cents a share, you still make $100 on 500 shares. Or if you wait, 2 more days and now it's 660 and you make 50 cents a share, which should have been the goal the whole time. So you see, I said this. My goal is to sell mid sixes tomorrow. I should have just edited this out. My goal is to sell mid sixes in the next 2 days. But again, as I hope you have learned, one of my big character flaws for trading is that I'm impatient. It's good and bad. When a stock can't hold breakout at 620, you should be selling. So I don't regret selling. I just regret that it works out this way. This is probably why so many traders get frustrated, because a lot of traders do have patience, they give it time, and sometimes the stocks don't break out and then they have a big loss. So I wouldn't change the way I trade. It's just frustrating. And, that's what successful trading is. This is not like a cakewalk, like where it's like, oh, let me just hand you $1 million. No, anything worth doing is not just going to be a cakewalk. So you have to put in a little time and a little effort. That said, there are some cakewalks every now and then. Here's just a few people who said, good job, Tim, first day here, just watching, you're the real deal. Volume Junkie bought 1,500 shares from 613 to 632. Craig Ford bought at 612, sold at 621. Not too happy about it, but I'm learning. Infernal Dante said, I did get into Zag at 620 and out at 635. Not a big game, but a W. So I just wanted to show you some examples of what some students were doing with this. So when they're making 10, 15 cents, no one's really happy or ecstatic, but it's better than a loss, and you learn. That is what is important. And if you focus on these plays where, you're like, God, Tim, you're making 5 or 10 cents a share. I don't care. That's not going to make me millions. But the same kind of setup might actually really help you bank. Let me show you ESI. So ESI was an earnings winner. You can see the big spike up right here. It was previously trading in here in the 3s, and they reported numbers, and it went all the way to the 5s. And this was in the morning. You can see at 9:30 a.m. And it spiked up at first, and then it downtrended. It hit a high, I think, of like 570. And then the low was like 5, and it was uptrending a little bit. I bought it right into the close because I was like, you know what, this is, even as long as it doesn't close near the lows, you always have to watch out for these companies that just spike really quickly at the open and then just continue to fade. That is not good. But this stock found support here, in the low 5s, and then it was uptrending, and I bought it at 558. Going right into the close. Like it was after, I want to say it was like 3:30 p.m. And it was kind of steady after hours. And then the next day, pre-market, it just started soaring. And when the market opened, it went from 6 all the way up to 11. And you're like, wow, why did it do this? It's not a volatile stock. And frankly, it was just a short squeeze. And I'll talk about short selling and short squeezes in the next chapter. But by focusing on buying an earnings winner, a company that had good news and a good pattern and it held its gains, this put me in the position. This is best case scenario. I've never seen another earnings winner do this on the second day, where it doubles from 5 to 11. And actually later, I think on the third or fourth day, maybe on the third day, it went to 14. So it was actually nearly a triple. And it's a beautiful thing. So just when you think that like, I'm studying to make 5 cents a share, it's so frustrating. Sometimes a stock that doesn't go your way and you make 5 or 10 cents a share, that same setup is applicable to a stock that goes, like freaking $10 a share your way. Or this one went, I guess, $8 a share. It's the exact same setup. So whether you hit like a single or you hit a grand slam, I'm teaching you the framework by which you should judge these trades. So here is my ESI. I said speculative earnings winner here. They had SEC filings pre-market today that spiked it, but no PR. And a conference call tomorrow at 11 a.m. So this is why I sold it so quickly, because I don't like holding into conference calls. I don't know what they're going to say. But they specifically said the conference call is at 11 a.m. tomorrow. So if I'm buying it at the market close one day and I know that the conference call, I won't be in the stock, the market opens at 8 a.m. pre-market. So I can sell 3 hours before the conference call. Or I think I sold it like 2 hours. I think I sold it at like 9 a.m. we have a timestamp? No, this is before we did timestamps on Profitly. Anyways, uh, 13 of the 16 million shares are short. And when we start talking about short selling, you'll see that's a lot. And, when this stock was down from like $40 a share, to cover your short, you have to buy. Buying pushes the price up. So when you have any good news on a really beaten down stock, some shorts can cover, and if a lot of shorts cover, you get a short squeeze. So by the time I even sent out the alert, it was now hitting 6, so I absolutely nailed it. Tons of execution problems on live chat with IB. Yeah, I remember this one. Oh, yeah. Sometimes you're going to mess up putting in your orders, and it's not going to be a fun process, but it happens to everybody. In fact, this is actually a very common thing with newbie traders and sometimes veteran traders. You make fat finger mistakes. I ended up selling, what was it at? 576 roughly. And I didn't want that. I was trying to put in the orders at 6 and they weren't showing up on the bid and ask pre-market. So I was like moving it around and I was trying to see like, why is it not showing up? I'm not used to trading New York Stock Exchange stocks, frankly. So I was moving it and trying to see it at different prices, and I moved it down to 576 and forgot about it for a few minutes. I was on the phone with Interactive Brokers support, and the stock started spiking all out of the blue. I couldn't cancel my orders before I got executed. I made a lousy 3% before the thing goes up 200%. I wasn't going to hold that long. I just wanted $6 a share. But it's a good lesson, and that's why I bring it up here. Not to make an excuse, whether I make $2,500 or $5,000, it doesn't change my life in any way. And it won't change your life in any way. If you're buying at 558, let's say 1,000 shares, and you're selling it at 577, 578, you're making $200, or you sell it at 6 and you make $500, or you sell it at 7 and you make $1,500. Like, the point is that the pattern is the same, and you have to choose, what is your comfort level? Do you want to go for the big one? I only show you all these things so that you can kind of judge the risk reward. On a $5 stock, I'm usually trying to make 50 cents a share. That was just my target. The previous day high, I believe it was like right in here. Yeah, it was like 570. So I go in thinking, okay, it's going to break out, and if it breaks 570, where can it go? And my guess was that it could go to 6, and it actually went to like 6.5 and then dipped, and then it really spiked here. But also, you have a conference call coming up right here at 11 a.m. So I specifically knew I wasn't going to be invested in this company when the conference call started. So, when there's a time limit on my trades, I'm not going to necessarily time it perfectly because I'm always aware that I have to be out at a very specific time. No different than, sometimes there's not a conference call at 11 a.m., but if you're a part-time trader, maybe you have to go into a meeting at 11 a.m. Or if you're at school, maybe you have a class that starts at 11 a.m., so you can only trade until 10:30 a.m. It's tough to trade with a time limit because sometimes the stock does what you want, sometimes it exceeds what you want, but it doesn't fit with your schedule. And that happens. The stock doesn't care about your schedule. But you should always take that into account. So I trade rather terribly when I have a time issue at stake. I remember I was buying the WATT IPO, one of the only IPOs I've ever bought just because they had wireless charging technology, which sounds amazing. And I bought it on a dip down from 10, and I bought it at 8, and I sold it at like 8.50, and 2 days later it goes to 16. But I was going to Turks and Caicos. My dog had gotten in, I was packing, and somehow the cap had come off on the Advil. So my little puppy had eaten like half an Advil. She didn't eat the center of the Advil, but like she had like bite marks on the outer part, and I wasn't sure if she ate the whole Advil, so I take her to the vet. In the middle of the trading day, I'm like checking WATT from the vet. I'm like, oh my God. Crazy stuff happens with life. All you can try and do is be prepared with the patterns the best you can. And that said, this was an earnings. These are all earnings winners. But you can also be a little more speculative. Earnings only come around 4 times a year. Remember that. So if you don't want to wait for earnings week, what would be another time where there would be some, amazing news that would fundamentally push up the value of a company? Well, I like buying contract winners. Da 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 da. here is Energy Focus EFOI. This was the press release they issued on September 11, 2014 at 9:05 a.m. They received the single largest order in the company's history, 7.7 million for the U.S. Navy. And, this is Energy Focus, sounds like a cool name, but they really just sell light bulbs. LED, very energy efficient light bulbs. And it's cool when they announce a contract like this, the largest contract ever. It's cool when they deal with the U.S. Navy, because any company that deals with military spending, their budgets are just massive. So if, one Navy ship wants LED light bulbs, then you have a lot of other Navy ships. So this is a very significant contract, but at the same time, it's not a very volatile stock. But the cool thing is that sometimes you can get some amazing run-ups just because of the short squeeze, which we'll talk about when I go over shorts. But, this is a fundamentally important event. So you can apply this to if a company gets a major patent, if they win a major court case, if they, I don't want to trade mergers and acquisitions. I don't want to trade FDA approval. I don't want to trade bank stocks. I don't want to trade commodities. So there's a lot of things I don't. Let's make it simple. Just buy earnings and contract winners. And there's usually 1 or 2 or 3 contract winners every single day all over the world with a small company and a big company, or a small company and a big government. Here's what EFOI did. Mind you, they issued this press release at 9:05 a.m. And each one of these candles represents 1 minute. So within the first 10 minutes, the stock went from 6 to 10. This is what I call an air pocket, where someone put in a market order or some short seller just got squeezed and it just kept going up. And it never did this ever again. In the 3 months since this has happened, it had a good 10 minutes and never again has it spiked like this. So if you can be there early, that's fantastic. I wouldn't chase this. This scared me. And I wouldn't bet against contract winners, because you never know. This is the exact reason why you don't bet against contract winners, because you never know how high it can go. Like, yes, it did drop from 10 down to 8, so there was a much easier $2 a share to be made over the next, half hour than if you got in right at the get-go. But this can happen to any contract. So remember this chart, and remember, I don't want to bet against contract winners, because a contract win, no matter how puny, is a fundamentally important event if it's a real contract. Not like with a small company that says, oh, we're partnering with FedEx, and they really just open up a FedEx account. That is not a real contract. But if they say, look, we have won $7.7 million that we previously did not have and previously did not announce, be very careful with that sometimes too. You got to research and you got to be cynical, because small companies sometimes reissue old press releases and they make it sound like there's an amazing new contract when they actually issued it 6 months ago, and maybe now the contract, they're actually like executing it. There's all sorts of subtleties, but this was a brand new contract and the stock went crazy. And my chat room went crazy. Jay Fern, got to give props to him. He is the one who spotted the news at 9:08 a.m. Again, I'm not a fan of spotting news, but it is very useful. With chat rooms, once you're in there, other people are spotting news and looking. And he says largest in the company history, makes it one to watch. Quick little spike just now. So he actually, I don't know if he found it through the news. Stockstotrade.com does have a news filter, or if he saw that it just had a quick little spike. Either way, he saw it pre-market. Then Kryptonian links the actual contract. MPW is watching it at the opening. At 9:40, Lonari says EFOI went nuts, got out with a $1,600 profit. So I don't know where Lonari 11 bought, but I'm glad that he sold into the big spike. Here's Drew. He got out with a $177 profit on just a $500 investment. So he made nearly 40%. And I sent this comment around to different mutual funds and people I know who think like, oh, Tim, that's a nice strategy, but I'm going to go with mutual funds. And they're going to make 40% maybe over 2 or 3 years. And this guy just made it in like 10 minutes. This is awesome. Ty Najian got in at 7:51, out at 9:34 for a $1,600 profit. I mean, this is like a 1 or 2 minute trade. So everyone who hates on penny stocks, this is exactly why I love them, because you can capture this. It looks crazy from the outside world, but again, if you're used to buying contract winners, this is an extreme case, mind you, but You buy it on the breakout. It broke out right from the get-go, and it would have had to be really quick, but you could have done well. And it was awesome. Rogomon made 600 bucks, chickened out, and took profits after a dollar upside. It's okay to chicken out. If you make a dollar a share in a 10 minutes, 15 minutes, that's freaking awesome. Here's EAJ. He actually says, Timothy Sykes, yes, learned much about taking quick profits from you, Tim. Got out of EFOI before it got halted and made $1,000 in 10 minutes. I actually tried buying this. I remember this now. And I didn't get executed. It was too quick of a run-up. That happens sometimes. And then this is a very simple comment, but very beautiful. In at 7, out at 9. All in like 10 or 15 minutes. Most contract winners aren't going to do this, okay? This is the most extreme example of any contract winner I've ever seen. But I'm just showing you that it's not just about earnings winners. So don't necessarily look for news, but be open to stocks that run up. And then look back at past, the intraday chart and try and buy it if it breaks out in the afternoon, ideally, over the previous high in the morning. That would be my favorite. Or ideally, if it breaks, a multi-week or multi-month kind of breakout like MAGS did when it broke above 5, when ZAGG did, which failed, but it still broke out above 620. Look for those key levels. Don't just buy this stuff randomly. Far too many traders just buy randomly. Speaking of buying randomly, here's another contract winner. Before I get to the next contract winner, here's EFOI. This is the day that it spiked, and you can see that it actually, ever since then, has just been terrible. It had one more follow-up spike, but all red candles every time it spikes. And this is why I say focus on, earnings winners, because earnings winners spike and they tend to hold their gains more, because one contract is nice, but it doesn't necessarily, change the whole value of the company. Maybe it's a one-time thing. Maybe it was already expected, versus an earnings win where the entire company has been doing fantastically, or at least above expectations, or maybe a new product is above expectations. Somehow it's the whole company and it's the whole operations rather than just one contract or one product. So that's why I'm going to give you, I don't know how many examples I just gave of earnings winners, like 10 winners. With contract winners, I'm just going to give you 2 examples, because contract winners, in my experience, they can run, but they usually fall. And, I don't like shorting them because you never know exactly how much they're going to run. But at the same time, I feel better about like a stock like ZAG, where even though it didn't break out the day that I wanted, it broke out 2 days later. So you always kind of have that safety net just in case you get stuck in the stock somehow. If you buy a company that's reporting earnings and it's in the process of being revalued at higher prices, whether you hold it a day or a month, if it holds above key resistance, key support, previous highs, if it holds just above it, then theoretically it should be able to rise over and over again for the next few days, maybe even the next few weeks, or in Facebook, in that example, or ACCO, and in many examples, VDSI, it can run up for several months. And that way, even if you miss timing, you have a very nice safety net. Everything I do, I miss time a lot, as you can see. These are just a few examples. I mean, I miss time almost every single trade somehow, whether I'm traveling, the Wi-Fi's bad, I get freaked out, I'm impatient, the stock is too choppy, I take too big of a position and I freak myself out. There's usually something that goes wrong. And yet, overall, I'm having a record year. And you have to think, Tim, with all the stuff that goes wrong, why are you making so much money and so much more money this year as opposed to previous years? It's because I've gotten more disciplined and I'm focusing on plays that really fit these patterns. There's positive news every day. A company can issue, look, we're announcing a new product. I used to buy those and chase, and I'd wonder why I wouldn't do so well. Now I really hone in on earnings winners, contract winners, and sometimes, when a company says that they're going to be doing press over the weekend, and that gets attention. And back in early 2014, when there was a Seeking Alpha story, and it could run for a few days. So there's just a few key indicators, and by focusing in on that stuff, I've really improved my results. Here is another contract winner. This was just the other day. And I'm actually going to include an entire webinar because I give weekly webinars to Trading Challenge students. So do my first 2 millionaire students, Tim Grittani. He gives bi-monthly webinars to challenge students. And Michael Good gives weekly webinars to challenge students. So I'm going to show you a whole 2-hour webinar that I did when TCCO announced this $3 million contract. And TCCO is a very small company, a nano cap, just a $10 million company. And I want you to watch the webinar and the follow-up video lessons before I go into other examples so you can see what I'm looking for to buy TCCO intraday, what makes me get out, and how you can learn from what I did right and what I did wrong. But I played this one pretty well, so I hope you enjoy this.